not coming here. Hello, 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 hello. Yeah. Yeah. So I'm just checking if everything is audible for you guys. If everything is audible, just checking on YouTube so we can start. Just checking it once. Is it audible? Can you just put a yes on the comments if anybody is watching? Audible, visible for you guys? Audible, guys? Just drop a yes on the comments. Hello? Okay. Hi guys, now we're going to start off with super fast marathon for revision for accounting standards for group 2. We're going to target how many our concepts that we can revise in 3 hours, and in the end, the last 20 to 30 minutes, I'm also going to target and solve a few RTPs. A few RTPs is going to be solved in this session. So let's try to cover as many accounting standards as possible. We're going to be super fast over here. Okay. So first, I'll just go in the same order, and this is purely going to be exam oriented. So an accounting standard can have 100 plus concepts or 20 plus concepts, but I'm going to focus only on those concepts which have been tested multiple times in the past and very, very important for the exam. Okay, so let's start off quickly with each standard. AS4, we all know AS4 talks about events occurring after balance sheet date. Now, what are the events occurring after balance sheet date? What is this standard mainly talking about? This is the start of the year. This is the end of the year. It could be any year, financial year, calendar year, June to July. They will give any financial year. Let's take the end as financial year. And we all know that balance sheet will not be prepared immediately. It takes some time to prepare the financial statements and approve it. Who approves the financial statements? Board of directors approve it. For a company, for a partnership, partners approve it. Once the board of directors approve it, then audit will be done. We will get audit report, and then later AGM will be held. We don't have to discuss about all of that. What happens after board of directors approve the financial statements is not our relevance in AS4. AS4 talks about this period, whatever I've shared here in rainbow color, right? It is this period, events occurring after balance sheet date, from the year ending till the date on which financial statements are approved by the competent authority, which is the board of directors. So in this period, if anything happens, can I go and rectify my financial statements in this period is the question. So sometimes in exam, they will tell a lot of things happen in this period, whatever is shared in yellow. You don't have to worry about that period. Just tell AS4 is not applicable. The scope of AS4 is only this period, guys. Only this period from the year ending till the financial statements are approved. So if something happens here, should I adjust in my financial statements? The answer is simple. We categorize these events into, everybody is aware, adjusting and non-adjusting. Non-adjusting is basically anything new that happens. What are the past exam questions that comes here? Company has invested in a new subsidiary after the year ending, for which negotiation started during the year. Some new event happened, some earthquake happened. These are all new events that basically what I have to do, just to give you an easy understanding, you do a time travel as if this happened on 31st March. See, even though this happened during this time period from year ending 31st March till board of directors approval, you imagine as if this happened on 31st March. So if this happened on 31st March, what would have you done? It would have been a completely new event, meaning as of 31st March, there is already a balance sheet, assets and liabilities. Is it something that is related to this asset and liability? So related to my existing asset and liability, some event is happening. Then it's not a new event. Then it is basically an event which is giving an additional evidence. The key word is additional evidence. It's an event which is giving an additional evidence for something that already happened on balance sheet date. So something that already happened on balance sheet date, we're only getting an additional evidence now. So for example, in balance sheet date, we might already be having debtors for whom we sold in the year itself. Now the debtor became insolvent. The debtor is not able to pay. In balance sheet, we have cash. During the year, somebody stole the cash. Now we found out who stole, how much they have stolen. So these are all adjusting events. For example, factory must have been there in 31st March. Then this factory is being constructed. Now the construction is the final cost or some legal, or let's say liability, that contingent liability. There is some legal case against the company already taken place. We don't know how much we have to pay. But during this period, the legal case became confirmed. So we have to pay. So very simple, guys. Something that already happened, it is reflecting in my balance sheet as assets and liabilities relating to that. Now we are getting an additional evidence, something that already took place. Now more information to change my balance sheet and liability. That's called an adjusting event. Completely new event, merger, lot of things will happen. These are non-adjusting events. So if it is adjusting event, you go and adjust the assets and liabilities. That's it. If it is non-adjusting event, you do not do anything. You just leave it, disclose next year. But however, non-adjusting events, we ignore it. But however, if these non-adjusting events are material, what do you mean by material? Important, sir. very important material transactions, then in that case, you have to see, is it affecting my going concern? Why? If it's going to affect my going concern, you can't disclose next year, because the things what I'm saying ignore, you will account in the next year. But I don't have a next year itself, because going concern is affected. In that case, if it's affecting going concern, it becomes an adjusting event. So basically, non-adjusting event, which is material affecting going concern, becomes an adjusting event. They will tell earthquake came, 2 crores loss, factory destroyed. How can I disclose next year? Factory itself is not there. So non-adjusting material going concern affecting event becomes adjusting event. Non-adjusting event, sir. Material, sir. Earthquake, 20 crores loss. Sorry, 20 lakhs loss, but not affecting going concern. My business will continue. Material, but not affecting going concern. It is a non-adjusting event, but I will disclose in the board's report. Basically, board's report under 134 of Companies Act, director's report. In that, I will disclose. So, non-adjusting material affecting going concern becomes adjusting event. Non-adjusting material not affecting going concern becomes a non-adjusting event. But disclosure in board's report for the purpose of true and fair view. And lastly, sometimes they will ask proposed dividend. Dividend is declared after the year ending. New transaction, so it's a non-adjusting event. That's it. That's what you have to remember for exam. This is with respect to AS4. Let's quickly go to AS5. I'm going to run through each standard in this rapid speed, quick revision of concepts. Okay. AS5 basically talks about net profit for the period. It talks about prior period items. It talks about accounting policies. It talks about accounting estimates. That's it. Very simple. Let's come in reverse. What is accounting estimate? Provision for debtors, provision for tax, things that we are not certain. NRV is an estimate. Accounting estimate, if you look at the balance sheet, it has full of estimates. Debtors has a provision. Or if you look at, let's say, investment is valued at fair value. Fair value is an estimate. Depreciation is an estimate. All these are, remember, depreciation is an estimate. So all these estimates that are happening, all that we have to do, guys, is these estimates will keep happening. These estimates keep changing. Today, let's say Vijay Mallya is my debtor. He is now in India. So I provided a small estimate of 5% provision. Vijay Mallya left India. Now I have to increase my provision because I'm doubtful if he will pay. So accounting estimates basically keep changing. It can even change 100 times in a year if the situation or circumstance changes, if you get new information. So result of new information, circumstance changes, accounting estimate changes. So whenever there is a change, you can change the accounting estimate, give disclosure why you changed. All you have to do is disclose in financial statements, hey, there's a change in accounting estimate. This is the impact on current year profit. This is the impact on future year profit. So impact on current year profits and impact on future year profits. That's about it. Accounting policies. What do you mean by accounting policies? We studied in AS1 Group 1. Accounting policies refers to specific accounting principles and the method of applying those principles adopted by the enterprise in preparation and presentation of financial statements. Did you understand anything? No. Don't worry about it. Very simple. Inventory valuation is an accounting principle. How do I do inventory valuation? I use FIFO or weighted average, correct? So FIFO or weighted average is an accounting policy used for the principle of inventory valuation. So inventory valuation is the principle. Valuation of asset, revaluation model or cost model is an asset valuation principle. How do I do valuation of asset? Either using revaluation or cost model. That is an accounting policy. Are you following, guys? Now, accounting policy, once you choose, like accounting estimate, can I keep changing? No. You need to decide properly. How do you decide? We have some elements, true and fair view, prudence, materiality, substance over form. But once you select an accounting policy, don't change. AS1 tells you can change if it's leading to better presentation of financial statements, change in law. Okay, I have changed. What is AS5 talking, sir? AS5 is saying, if you change, what is the impact on profit this year? What is the impact on profit next year? For example, inventory valuation. FIFO inventory is, for example, valued at 20,000. Weighted average value is 35,000. Because my closing stock has now changed from 20 to 35,000, my net profit and gross profit will increase by 15,000 this year. What will be the impact in next year? That's it. That is the inventory valuation, accounting policy impact. That's it. Prior period items, very, very important for your November 23 exam. Expect in the exam. Prior period items is basically, in the past I have done a mistake. Remember guys, in life everybody does mistakes. So if you do mistake, give me a chance to rectify it. In 1990, in 1890, doesn't matter. How many ever years back, 2005, I made an accounting mistake which is material, which is an error or a omission of accounting. Error means instead of using SLM, I use WDV. I made some mistakes in applying the accounting policy. Borrowing cost should not be capitalized, I capitalized. An asset which should have been capitalized, I debited to P&L account. Income, I forgot to record. I received interest income, I did not record. So any error, mistake in arithmetical mistake in applying accounting policies are there, or omission, forgot to account, any error or omission in the prior accounting periods, financial years, if you notice this year, make a change this year, so this will impact the profit of this year, you disclose in the financial statements, hey, there is a change. Because of my profit this year, because of previous year change, there is a profit impact this year, and what is the profit impact next year? Sir, I did fraud in the previous year. Can I correct this year? You correct, but AS5 not applicable. AS5 applicable only for error and omission and not for fraud. That means anything done intentionally, AS5 is not applicable. Next guys, net profit for the period comes from ordinary activities or it comes from extraordinary activities. Let me give simple examples. Elon Musk in Twitter firing half the employees, ordinary or extraordinary activity. Let's say I am woodpecker furniture shop. When I make furniture, I'll be left with some sawdust, waste furniture that I am selling. I'm a newspaper company, extra paper I am selling. Are all these ordinary activities? Yes, Elon Musk firing, woodpecker selling the sawdust, or me selling some waste in the business. Everything is ordinary activities. They are saying ordinary activities are those activities that arise from business or which is incidental from business or incidental from business happening in the ordinary course of business. Arise or incidental or also for the purpose of furtherance of business. Look at the wordings they use in the definition. We are not going to definition. Any activity that arises from business or is incidental from business or furtherance of business. I have a material for accounting standards. I am not showing you material because you have material. I don't want to go to a material and you will read the material in 3 hours. We are just revising and brushing up concepts. Concepts are same wherever you learn. Okay. So anything which arises from business or accidentally happens from business or incidentally happens in the business or for furtherance of business becomes ordinary activities. For example, Elon Musk firing employees is necessary to continue further the business forward, correct? So all those becomes ordinary activities. Extraordinary activities are very limited. If they use the words like earthquake, extraordinary is very extraordinary. Earthquake or attaching property of a person or refund of government grant. Only these three guys. Consider only these three for exam for extraordinary: earthquake, attachment of property or refund of government grant. Everything else is ordinary. But between ordinary and extraordinary activities, some things which you feel, however it can be ordinary, like sale of fixed assets, any fire or asset or liability revalued, because we don't do this every year. Fixed asset is not sold every year. Fire doesn't come every year. Asset inventory, revaluation to its NRV, writing off of asset or writing off of asset, all these don't happen every year. Or any litigation loss, litigation case loss, these are all exceptional items. So in exam, I'll ask you to classify as ordinary, exceptional, extraordinary. Extraordinary, predominantly it will be only these three: earthquake, attaching property and refund of government grant. Exceptional, there's a small list. These are exceptional activities, rest everything will be ordinary activities. And any other item which is of importance, sometimes they'll give an exam. I got loss from fire, 4 lakhs. I sold fixed asset, got profit of 6 lakhs. Can I set off both and show net profit of 2 lakhs? No. Both are material transactions. So show sale of fixed asset separately, loss from fire separately, both in the P&L for purpose of disclosure. That's it. This is about AS5. Now let's go to AS7. I'm hoping the speed is fine. Quickly drop in the comments if you're understanding on YouTube. Let's proceed, guys. Okay, just one moment. AS7 mainly talks about how to record for contract revenue. Why, sir, should I record for contract revenue? This revenue of construction project goes for multiple years, 3, 4 years, correct? So parties might pay at a different time, work is done at a different time. How do I account an exam? That's the problem. Exam sums are simple, guys. I'll give you the steps. This is going to be exam oriented. Logic, we have accounting standards for 30 hours. We don't have time. Exam is hardly in a few weeks. So we're going to focus exam oriented. Even if you didn't study what to do for exam, we're going to also, like I said, solve a few RTP questions in this class itself. First one, guys. Okay. What are we going to do? They will first basically ask you to account year 1, year 2 and year 3 revenue. Okay. Assume total construction contract price is, let's say, 300 is the contract price. I'll give you some random numbers equal to exam sum. So how much revenue should I account in each of the year if total contract price is 3000? You have to ask yourself how much cost is incurred. Okay. First year 100, or let's say first year 150, second year 50, third year another 50. What is the cost incurred in first year? Step 1, cost incurred in first year, incurred till date, divided by total cost to be incurred on this project. Total cost to be incurred on this project is 150 plus 50 plus 50, 300, correct? 200, 250, okay. Or let's assume, let's keep it for simplicity purpose, let this also be 100, okay. So total cost to be incurred is 300, I incurred 150. So the formula is cost till date divided by cost till date plus future cost, estimated cost to be incurred, which comes to 50%. I'm going to incur 50% of the cost now, correct? So if I'm going to incur 50% now, what I have to do is very simple. In this case, 50% will be recorded. So if I prepare my year 1 financials, 300 is the contract price into 50%. You are going to find something called percentage of completion. So apply 50% here, 150. What is the cost till date? 150. Therefore, net profit or loss for the year is 0. Simple, guys. Step 1, find cost till date. Step 2, find future cost to be incurred. Step 3, divide cost till date divided by cost till date plus estimated total cost. You find a percentage, cumulative basis. This percentage is, what to say, percentage of completion. This is called cost to cost method, percentage of completion. Step 4, apply this percentage on the contract price. Apply on contract price. Once we apply on contract price, you will find revenue for this year. We will find revenue for this year. You account here cost till date over here. We will find net profit. Now, additional step. For example, if after applying all this, the contract revenue to be recorded as 200, but the cost till date is 250. That means this year I have a loss of 50. Whenever you have a loss after applying all the above steps, you have to do a simple thing. Total contract revenue minus total contract price. Total contract revenue, maybe it's 400. Total contract price, maybe it's 520. That means you will basically have a total loss in this project of 120. I'm just giving random numbers. So in 120, you've already accounted loss of 50. Remember, whenever there is going to be a loss current year in the construction project or any year, prudence concept, estimate what could be the loss in the future years. Estimate what could be the loss in future years. Here the loss in future years is already loss is 120 minus 50. So 70 is going to be future year loss. Account that also. Recognize full loss in the current year. So let me repeat for construction contract, very simple. Step 1, find cost till date. Step 2, find total cost to be incurred. Step 3, cost till date divided by total cost and current cost, find percentage of completion. Apply this percentage on contract revenue. You will find a percentage. Apply that to find current year revenue, which will be accounted, current year cost. If it's a profit or no profit, leave it. But if it's a loss, even find the foreseeable loss that is going to be incurred in the future by minusing total contract revenue minus total contract price. You will find a total loss, out of which already current year some loss accounted, so balance has to be accounted. That's it. This is what you will get exam sums. We are going to do today. Wait for the RTP, there will be a similar sum like this. Okay, fine. I'm going extremely fast, guys. Normally in this time AS4 introduction would have been done. We're just revising all the key concepts for exam. Next, going to AS9. AS9, 3 hours. How many concepts in AS can you revise quickly and do one RTP is going to be super effective. AS9 basically talks about two things. What is revenue? How to account for it. That's it. It talks about two things. What is revenue and how to account for it. Revenue is defined as gross inflow of money. Revenue defined as gross inflow of receivables, cash or other consideration. Gross inflow of receivables, cash or other consideration. What do you mean by gross inflow of receivables, cash or other consideration? Credit sales, cash sales or other consideration means revenue also includes barter system. It also includes barter system. Revenue from where? If I take a loan, is it revenue? No. Revenue from receivables, credit sale, cash sales or barter system, from sale of goods or rendering of services, or they say use by others of enterprise resources yielding interest, dividend, royalty. That's it. Exam oriented. Basically the standard talks about how to account for revenue, credit revenue, cash revenue or barter system revenue from sale of goods, rendering of services or used by others. I'm going to get interest, dividend or royalty, and it also includes for some special transactions like consignment, sale or return basis, agency business. That's it. This is the point of revenue in exam. We're going to see quickly for each thing how to account for revenue. Whether it's credit sale, cash sales or barter, doesn't matter. But situation, let's see situation. First, in case of sale of goods, before even going to all of this, there are two primary conditions which are important. Sometimes they test on this. I'll give an example. I'll give an RTP example also. They say no uncertainty in amount, no uncertainty. You know it. Repeat loudly in the house, guys. Repeat loudly. Don't look at my face. No uncertainty in ultimate collection. If you're watching, watch till the end. 3 hours, look how much you can revise. No uncertainty in amount, no uncertainty in ultimate collection. Sir, exam question, what will come, sir? RTP, 2 years back RTP, what they asked in my RTP question, and in exam also it came. I made a credit sale to my debtors. He should pay within 3 months, but he has not paid for 6 months. Amount is 10,000. I want to charge 2% interest for the delay of 3 months. He is supposed to pay in 3 months, he is paying in 6 months. So 3 months delay, correct? There is a 3 months delay. Can I record this revenue? Answer is no. Why? Because debtor money, this 10,000 itself, if he is paying, it's doubtful. How will he pay interest? No uncertainty in amount. Amount is certain. For 3 months, I can compute the interest. But will he pay? No uncertainty in ultimate collection. Why will he pay? So, before you account for revenue, imagine you go to a shop. You will tell him, I will come tomorrow and buy. You left. Can I account for revenue? No, because amount may be certain, but there is no uncertainty. There is uncertainty in ultimate collection. So only if both are clear, amount is certain, definitely you will pay. No uncertainty in ultimate collection. Then I will account for revenue. Now when to account for this revenue? Coming back to that point, sale of goods. In simple, the keywords, what to write in exam in theory to get marks? Transfer of risk and rewards. Transfer of risk and rewards, guys. If risk and rewards are transferred from Foundation Sale of Goods Act, basically he is saying reward is property in the goods. Property is nothing but ownership. Risk follows ownership. So whenever ownership is transferred, You have to account for revenue. Sometimes they'll give question. Seller sold the goods, but buyer requested the seller to keep the goods with seller itself. How many times have you seen this question? Seller sold the goods, but the buyer will ask the seller, you please keep the good with yourself. So I kept the good with myself. Now good got damaged or good got destroyed. Who should bear the loss? Buyer. Or can the seller account for revenue? See, seller made the sale, but buyer requested the seller to keep the good with the seller itself. Because buyer requested, even after sale, seller is keeping only possession of goods, ownership is transferred, risk and rewards are transferred, so I will account. This is a common question in exam. So the 3 key points you should write is, goods are in seller's position at the request of the buyer, but sale is already done, ownership is transferred. So sale of goods, exam what remember when risk and rewards are transferred. Okay, sir. Next is what about service, sir? How do I account for service? Look at this. Some services like school or internet or mobile telecom goes prepaid, you pay for 1 year. Service goes for a long period guys. You think of everything else. Let's say college, you pay fees for 1 year. It goes for long period. Let's say you pay fees in the month of Feb till you paid in the month of August. So Feb to August, there are few months. How to apportion the revenue for Feb and March? 2 months. How to apportion for April, May, June, July, August? 5 months. How to apportion? Whatever revenue comes in, can I apportion using time ratio? No. If revenue goes for a long period, basically they use the word revenue is going for a revenue is having multiple acts for a long period, the accounting is on a percentage of completion method. Percentage of completion method means on a proportionate basis. Let's say you paid fees for a class, college or whatever. You paid fees in Feb and joined class in Feb. But class started only in May onwards. Then you will not account for revenue in Feb and March. You will account for revenue only from May. Are you following, guys? It is not about time basis. It's not about when you make the payment. It's about when the service is performed. For example, for IPL advertisement, you would have paid now this month and booked the IPL of next year, 2024 IPL. Dhoni ad you booked now by paying to BCCI, paying to Dhoni, paying to Star Sports. Now, Star Sports, BCCI, Dhoni will not account revenue now. When the ad is coming, when they performed it, when it's coming on TV next year, Dhoni will record now because he performed ad now. But BCCI and Star Sports, when are they telecasting the ad? In May next year in the IPL. Correct? So that time when the service is performed, percentage of completion based on when it's performed. Okay. This is in multiple acts, long period. Now same thing if it's a single act. At one point, went for a movie. Last night I went for a movie show. Movie started at 10 p.m. Got over at 1 a.m. Now PVR will account it yesterday or today. Are you getting it? At 10 p.m. I booked the movie ticket. 10:30 I went for movie. Got over at 1:30. Finished the movie. Came home at 2 o'clock. PVR will record the revenue at 10 p.m. or at 2 a.m. after movie. Simple. Single act. Saloon, you went for a haircut. Zomato, you ordered food. Single act. Individual act happening at one point. Start and completion is generally same day or next day, few days. Then you account very simple. After service is completed. After the service is completed. So very simple, guys. Service is happening at a single point of time. Service is happening over a period of time. Over a period of time, use percentage of completion method. Single act when service is completed. Okay, fine, sir. That is done. Next, interest I will account on accrual basis. Accrual basis means when I am supposed to receive it based on accrual or not based on actual receipt. You never account anything on actual receipt in financial statements. Everything is accrual. Credit sales, we account when the sale takes place, not when we receive. Same way if I am accounting for interest, account on accrual basis. Not able to understand, sir. 31st March is the year ending. Interest will be received on, let's say, 1st May. But interest is payable from 1st Jan. I am going to receive the interest only on 1st May. So, my money will come. Bank account to interest income will come only on 1st May. But for these 3 months, I will pass interest accrued to interest income. I will pass a receivable entry. That only is interest accrual basis. Sir, what about royalty? What is royalty? A.R. Rahman has terms and conditions currently trending. Okay, so terms and conditions for royalty. Anirudh might have terms and conditions. Any copywriter, movie director can have terms and conditions for royalty, how to earn the royalty. For example, if you take this Friends TV show, the cast, all those people you watch on Friends, they acted in 1990s. Still the show is coming on OTT platforms. Still it will be trending top 10 in India or the world. Today if you watch a Friends TV show, they acted in 1990, they will earn because of royalty. Okay, so royalty you have to account based on terms and conditions based on each case. If you don't know what the terms and conditions are, account on accrual basis. So royalty also terms and conditions, otherwise account on accrual basis. Next, dividend. How to account if I receive dividend, sir? You don't have to account anything on cash basis. You know, financial statements are prepared on accrual basis. So dividend will be accounted again based on right to receive. I'm giving you all the keywords, guys, based on right to receive basis. Right to receive basis means whenever the dividend is declared. Because in 123 of Companies Act you have studied, once dividend is declared, it has to be paid within 30 days. Has to be paid within what, guys? 30 days. So once dividend is declared, once right to receive is established, you will account for it. Once right to receive is declared, once right to receive is established, we will account for the same. I am hoping this is clear. Understood, guys? Okay, super. Next, go to next one, guys. So dividend is done, interest is done. Let's summarize. Sale of goods when risk and rewards are transferred. So services, remember, recall, don't look at the board. In exam, you're not going to have a book. Recall, guys, recall. Services, multiple acts, single act, multiple acts, percentage of completion basis. Single act when service is completed. Interest, accrual basis. Royalty, terms and conditions, accrual basis. Dividend, right to receive. Last one, agency, consignment, sale or return or sale accrual basis. Agency business. Now, let's say Swiggy, you ordered for 250 rupees. They have to pay 200 rupees to restaurant and their commission is only 50 rupees. For agency business, let's say in Make My Trip, you book flight ticket with Indigo. Ticket is 5,000. Commission is 200 rupees. For an agency business, gross money is not this. It's not what they collect from you. What is their commission? That only is revenue. That's it. There's an exam. There's a question. For agency business, the revenue is commission only. That's all for exam. What about for consignment business? For consignment business, the revenue, let's say there is Hyundai showroom consignor. Hyundai sent goods to dealer, let's say showroom. And from showroom, you went and bought a new i20 car after finishing CA. Dream for it, guys. While studying, dream that you're buying a car. Then you'll push yourself for the next 10 days, 15 days, how many days left for exam. Okay, so the consignor sent goods to consignee, the dealer, and dealer sold to the customer. You imagine you buying, why Hyundai, sir? Let's change to BMW car. Okay, you bought BMW car. Fine. Now in this case, guys, very simple. When will Hyundai record revenue? Not when the goods are sent to the dealer, consignor. When the goods are purchased by consignee. I will record an account for revenue when the goods are purchased by consignee. When accounted by consignee. When consignee gets the goods, I will account for it. Are you following, guys? Are you following? So when the goods are finally sold to consignee, no. How can you say you're following? You should have immediately striked in your mind now. Sir, you told wrong statement. I intentionally told it wrong. You just cannot listen without having attention in the class. Come on, guys. I'll repeat. When consignor sends goods to consignee, we don't account for revenue. Only when the consignee sends to the third party, customer buys it, only then revenue is recognized in consignment. Last one with this AS9 comes to an end. Sale or return basis. Sale or return basis. In sale or return basis, goods are sent to somebody for them to inspect, take a week or month time or 2 months and then tell if they want to buy or not. Imagine sometimes we buy shirts or clothes come to our house. One big bag of 20 shirts will come. I will select 5 and send the balance. So in simple, in sale or return basis, when the customer to whom the goods are sent accepts the goods, you will account for revenue. If he rejects, you will not account for revenue, you will reverse the sale entry. You will reverse the sale entry. Accounting you study in foundation itself. Simple. Here they won't ask accounting. Is it revenue or not revenue? If customer accepts, yes, revenue. Rejects, not a revenue. Next, imagine you send goods to customer. I send shirts to customer. I told him to reply within 7 days. Reply within 7 days. If he accepts within 7 days, revenue. Rejects within 7 days, no revenue. 8 days over, sir. No reply. Ignoring me. No reply. Ignoring me. After the time fixed before which you have to accept, it is deemed as sale. Therefore, I will account the revenue. Sir, can you repeat? If time is fixed, if the buyer or customer does not reply within the time fixed, then if time is passed, then I will account for revenue. Sir, no time is fixed, sir. How long should I wait? By mistake, I did not fix time. Known person I gave trusted, did not tell him time. He did not accept. He did not reject. He is ignoring. Then the law says reasonable time. If the time is beyond reasonable time, no reply, account for revenue. So simple. When to account for revenue on sale or return basis? When the customer accepts the goods, account for revenue. If he rejects, no revenue. Time is fixed. He accepts within time, account for revenue. Time is over. He did not reply, then don't account for revenue. No time fixed. Wait for reasonable time, reasonable period. After reasonable period also, no reply. Account for revenue. Within reasonable period or within time fixed, he rejects. Don't account for revenue. Able to follow, guys? That's it. This is the end of AS 9. So we quickly revised AS 4, 5, 7, 9. In 7, remember guys, there is one more concept called segmentation of contracts and combination of contracts. What is this, sir? Very simple. If you apply for multiple projects with government for construction, let's say flyovers, can I merge all the projects into one and account as one contract? Segmentation? No, it's called combination. Multiple projects, if can I call them under one contract? It's called combination of contracts. No, treat each project separately. It's called segmentation of contracts. If the cost and revenue for each contract is separate, timelines for each is separate, profits for each is separate, then application for each is separate and separate contract is made for each, it will be segmentation, separate. I can't merge. Sir, one bulk amount is given for all the projects. Even though timeline is different, one bulk amount, a single contract is made with the same party, then combination. And also one more important thing, the government, if it has the ability to accept a few and reject a few of the projects, it's segmentation. If government can only accept all or reject all, then it is combination, because they don't have the option or power to split the contracts itself. Following, guys. And sometimes in contract cost, you'll also see if the revenue increases or cost increases, it's called escalation clause. Then you will also correspondingly increase the percentage of estimated cost to be incurred. Able to follow, guys? This is AS 4, 5, 7, 9. Next we are going to go to 9 is over. No 10, 11, 12, 13, 14 for us. We are going to go see 17 and 18, then 19, 20. Till the end, we will revise all the standards and let's go and see last 2 RTPs to the extent possible. Okay. Okay, I'm hoping you got a time to breathe, understand, and I got a time to breathe. Of course, 3 hours means I'm not going to continuously keep talking for 3 hours. No break and all for 10-15 minutes. But the short 30-second breathers will be given because I need it, you need it. Okay. Now, next one, AS 17, examiner's favorite pet standard. Leave November 23. Past 5 attempts, at least 4 times it came. In the past 5 attempts, at least 4 times it came, guys. That means every time I can't tell it won't come next time. It can come even in November 23. Last time, old syllabus. Follow guys, purely exam oriented, and that too examiner is asking only one question. Only one question in this standard, and that is the exact thing I'm going to focus on. Okay. So let's take a company like, let's say, if you say ITC. ITC has multiple products, stationery, hotels, FMCG, then FMCG includes all this biscuits, yippee noodles, then you have, let's say, cosmetics, etc. comes in FMCG but separate, or their main product, tobacco products. As an individual in revenue, if I write total revenue, ITC's revenue for the information latest year is close to 70,000 crores. Don't you want to know breakup of which is accounting for how much revenue? Correct. That is called A17 segment reporting. So this standard is basically 3 parts, guys. First, or basically I will say it's 4 parts, and I'm going to focus on the exam oriented area here. First, they are saying there are all products or services which are given. For example, just now I showed for ITC, there are so many products and services. There are so many products and services for ITC. Correct, guys? So many products and services. We just now listed them. Can I show, like if you take for example HUL or Tata or Reliance, they will have 100 plus products and services. Can I prepare a financial statement or revenue statement with 100 columns of breakup? No. We know a concept of relevance. So from all the products, I have to classify them into segments. I have to classify them into segments. That means in ITC, all this biscuit, eatables, yippee noodles, chips, bingo, all this will come under food. Shampoo, Fiamma Devil, soap that they have, all this will come under cosmetic products. Notebook, pen, pencil, sharpener, rule notebook, unrule will come under stationery. So the first thing is, it's part of a syllabus classifying all products into segments. Let's say there are 100 products. Now I have classified into 7 segments. Now, for this there is a definition. How to classify? Classify on geographical basis, country wise or business basis, based on nature of goods, products and services. Based on products and services, I can classify nature of products and services. Based on the risk, method of production, method of distribution, I can classify the products and services. We have a definition. Either business segment or geographical segment. That's a definition. Then these segments, again I don't have to show all the segments, because 7 segments means 7 columns. So from these segments, I will classify something as reportable segments. So out of these 7 segments, I might report only 3 segments. Guys. We don't have to show all 7, and this is what examiner likes. How this 7 becomes 3? They have to pass some test, like how you have exam. These 7 segments will go through test. They have 5 tests, guys. That's what I'm going to focus on in this video. Okay, there are 5 tests. These 7 segments will go through 5 tests, and then it will become 3 segments. Then these final 3 segments will be reported. Standard comes to an end. This is the whole view of the standard. First, identify total number of products. Classify products into segments based on similarity of products, geographical segment, business segment. Then these segments will be classified into reportable segments, which goes through 5 tests. That's what we're going to discuss. And these tests will be reported. How I will report? Very simple. I will write particulars, segment 1, segment 2, segment 3 in our case. Others are the other segments, and then I will write total. Here I will write segment revenue, segment results, no expense, then segment assets, segment liabilities, and lastly others I will write 2 things: addition to fixed asset, depreciation of each segment. Or in other words, we will write non-cash expense. That's it. This is the final format. They have never tested, so I'm just hardly spending a few minutes. The format will be like this: particulars followed by segments that I'm going to report. Then I will write others column, and then I will write total column. Following, guys, in this segment revenue, what are the breakups for each segment I will show? I will show segment revenue, I will show segment result, I will show segment assets, also segment liabilities. Then under others, I will show addition to fixed asset and increase, any non-cash expense to find cash flow. Addition to fixed asset, why we are showing? To see which segment more investment is made. Fine. Sir, I want to focus on exam. I gave you overview of standard 5 tests. That is the most important thing. That's why I am going to focus now on these 5 tests. Okay. I will classify these 5 tests just for our purpose of easy understanding as 10% test and other test. 10% tests are classified into 3, guys. Classified into 3. We are going to do a sum in RPP also today. I am going to do segment asset test, segment revenue test, segment results test. AS17, if you are skipping for exam, at least read these 5 tests. Only this is tested in the last 5 attempts. I'm not joking. Go check the papers. Others, we have something called discretionary test and 75% test. This is what I'm going to brief for the next 5 to 10 minutes. Okay. Segment asset test is very simple, guys. Like you can guess, divide segment asset divided by total asset of the company. If I take ITC, stationery department, stationery segment, total assets of stationery divided by total assets of the firm or of the company, is it at least 10%? That's why it's called 10% test. Then that segment will be reported. For example, if segment 1, segment 2, segment 3 are there totally, if the assets is 50, 50, 20, okay, or let's say 50, 50 and 5. The total of segment assets comes to 105. In that, what is 10%? 10.5. Any segment crossing 10.5 will be reported. Segment 3, since it's not crossing 10.5, we will not report, equal to or more. So segment asset test is segment asset by total asset. Segment revenue also is simple, guys. Like you can predict, it's going to be segment revenue divided by total revenue. Same formula, assuming the same numbers, 50, 55 is revenue. My revenue of each segment should be at least 10% of the total company, then I can report it. Are you following, guys? Okay. What are the key things to note here? In the segment revenue test, remember to include internal plus external. Sir, numerator or denominator? If you include something in numerator, you have to include in denominator, both. So segment revenue test is segment revenue divided by total revenue should be at least 10%. Which revenue? Internal plus external. Sir, what about segment assets? Total assets. Will I consider all assets? Answer is a big no, guys. You only consider those assets which are related to the segment, or even if it's not related, it can be apportioned to the segment. For example, few items like advance tax, deferred tax asset, these things should be eliminated. For example, in the same sum, if deferred tax is 10, then from the denominator in the sum, from denominator 105 you reduce 10, because out of the total assets 10 is deferred tax, and from numerator also, from each segment you remove deferred tax. For example, in segment 1, if deferred tax out of 50 is 5, you reduce 50 minus 5 and do 45. In segment 2, out of 50, if it is 4, then 50 minus 4, you will do 49 divided by 101. Segment 3 only 1, then 5 minus 1, 4 by 101. That means from the total computation of numerator and denominator, those assets, we call them as corporate assets, like what, guys? Advance tax, deferred tax, certain assets like prepaid expenses which cannot be allocated to one particular segment should be removed from the overall thing. Should be removed from the overall thing, and then the balance only will be, what to say, a portion. Balance only we will apply the percentage. So what to remember for exam? Segment assets by total assets, we will do a sum also today. Take segment assets by total assets including only relatable assets. Corporate items will be removed. Segment revenue by total revenue, take internal plus external revenue. Now going to segment result test. I will give a sum itself. Let's say we have segment 1, segment 2, segment 3, segment 4, segment 5. Segment 1's revenue is 300 profit. Segment 2 is 400 profit. Segment 3 is 500 loss. Segment 4 is 30 profit. Segment 5 is 50 loss. Or let's say 20 loss. How to do it? Steps. There is a logic, but we don't have time for the logic. It's a beautiful logic. We'll discuss after the exams. Then I'm going to ask logic in exam. What I need in exam? Step 1. Compute total profit only. Only profit. 300 plus 400 plus 300. 730. Total profit only. 300 plus 400 plus 30. Total loss. 500 plus 20. 520. Don't write bracket now. I want mod. Number alone. Absolute number. Between total profit and total loss, individually, only loss and profit, which is higher, total profit is higher. So this becomes my base. Apply 10% on the total of profit. Apply it, sir. How much I'm getting? 73. I'm getting 73 as the total profit, 10% of 730. Therefore, any segment that crosses 73 will be reported. 300 crosses 73, yes, reported. 400 crosses 73, yes, reported. 500, sir, it's negative. Ignore the negative sign. 500 crosses 73, yes, reported. 30 doesn't cross 73, no, don't report. 20 doesn't cross 73, no, don't report. So my reportable segments as per result test will be segment 1, 2, 3. I hope you have understood the steps and application of steps equal to an exam sum. So we are done with our 10% test. Done with 10% test. Others. What is discretionary test? What do you mean by discretionary test? Optionally, they have never tested this, but if it comes, optionally, the company can choose on its own. The company can choose on its own to record or disclose any segment which is failing. It has failed all the other tests. It has failed all the other tests, but optionally I can still disclose this. Are you following, guys? If I want, I can disclose. Are you understanding, guys? Optionally, I can disclose this for the purpose of my own choice. Management decides this segment is not going to pass any test, but we want separate disclosure because of nature of business. Apollo Hospital getting into some, let's say, IT work, IT companies, even though it's small, disclose separately. Last one, 75% test. My gut feeling is either they will test the 75% test this time in November 23, or they might test something I'm going to teach, a beautiful concept called comparables might be tested. That's my gut feeling, guys. Comparables or 75% test. 75% test says you apply all the other tests. Finished applying. Okay. What is the total revenue? Write down. What is the total revenue of reportable segments? Sir, I'm not understanding. Out of 7 segments, we reported 3. I showed you 7 segments, we reported 3. Or out of 20 segments, I reported 5 segments. Total revenue of reportable segments. So I'm comparing total revenue of reportable segments and total revenue, but this is going to be only external revenue. It's going to be only external revenue. The total external revenue of reportable segments should be at least 75% of total company. Are you following, guys? If the total revenue of the entire company is 500, okay, the total revenue of reportable segments, let's say totally company has 7 segments, all 7 segments, total company put together revenue is 500 external. Only 3 segments are reported, S1, S2 and S3. For S1, S2, S3, the total revenue of reportable segments comes to 250. So, total revenue of reportable segments, total external revenue of reportable segments divided by total external revenue is only 250 by 500, which is 50%. No, not sufficient. This percentage should be at least 75%. So, I will have to keep adding segments. I added S1, S2, S3, maybe add S4, maybe add S5, my choice. Keep adding more segments in the numerator such that the percentage of external revenue reported out of total revenue is at least 75%. This is called 75% test. So we are done with all the 5 tests, guys. Done with all the 5 tests important for exam. Asset test is basically segment asset divided by total asset. We consider only relatable assets. Then segment revenue test is revenue by total revenue. We take only internal and external both. Result test simple. Find total profit, total loss, whichever higher, apply 10%. Any segment crossing the 10% will be reported equal to a 10%. Discretionary, optional, and 75% test we just now saw. The 75% test basically says total external revenue of reportable segments should be at least 75% of total external revenue of the firm. Are you following, guys? Are you following? Hello? Clear, guys? Okay. Now, next thing, guys. Next thing, something which has never been tested and I have a gut feeling. See, if it's a super crash course, I should not be taking this. But I have a gut feeling this will come because for November 23, this question has been roaming in the RTP. So if they ask case 17, this is a high chance. So let's say my company has segment 1 to segment 7. In year 1, I reported segment 1, segment 3, segment 4. Year 2, I reported segment 1, segment 5, segment 6. Year 3, I am reporting segment 6, segment 7. Okay. Segment 1 is because of, let's say, asset test. Segment 3 is result test. Segment 4 is discretionary test. Now, should I apply the test each year? Yes. Each year, apply the test independently. So, year 1 out of the 7 segments, I reported 1, 3 and 4. Year 2, again I applied the test. Segment 1 again passed in asset test. Segment 5 passed in result test. Segment 6 passed in 75% test. These are tests which passed in that year. But we prepare current year and previous year. So in this case, what will be my previous year? So segment 1 is there in year 1, it's there in year 2 also. Good. But segment 3 and 4 is there in year 1 but not there in year 2. How do I account in year 2? The segment 3 result test will automatically come here. So plus segment 3. But segment 4 discretionary test will not be carried forward to next year. Sir, I am not understanding, sir. I understood what carry forward. Why? Very simple. Anything which passes, anything in simple terms for exam, anything which is passing the 10% test, anything passing what, guys? 10% test, anything passing the 10% test will automatically be reported. Anything passing the 10% test will automatically be reported for the next year. This is year 2. Sir, what happens in year 3? Follow, guys. Year 3, segment 6 passed again asset test. Segment 7, let's say, passed 75% test. What will be carried forward? First from year 2, segment 1 passed asset test. So plus segment 1. Segment 5 passed result test in year 2. So plus segment 5. Segment 6 passed 75% test but no carry forward because it's not 10% test. Sir, what about segment 3? It is coming from year 1. Can I carry forward for one more year? Answer is no. This is called comparables. Can you summarize in one line, sir? Any segment passing those 10% test, revenue test, result test or asset test alone will be carried forward to the next 1 year if not selected in that year. That's why you can see here from year 1 segment 3 is carried forward only to year 2 but not to year 3. Year 2, what are the new 10% tests will be carried forward. That's it. Exam don't write 10% test. I told you for understanding. So it's asset test, revenue test or result test. These 3 tests only if you pass, it will be carried forward. Anything which passes the 75% test or discretionary test is like a balancing figure of that year. That will not be carried forward to the next year. That will not be carried forward to the next year. I hope you understood with this example in this speed. So we are also done with AS 17. So 4, 5, 7, 9, 17 is done in 1 hour. Let's proceed to the next set of standards, starting off with AS 18. Okay. AS 18 basically talks about related party disclosures. The myth behind the standard is it's a scam standard. People are trying to do related party transactions. No. Imagine Tata Steel, Tata Cement and let's say Tata Motors. Now Tata Motors is launching a lot of electric vehicles. So they're building a new factory for construction of electric vehicles. For the purpose of steel and cement, will Tata Motors buy from somebody else or will they buy from Tata Steel and Cement? Of course they will buy from Tata Steel and Cement. Yes. Yes or no, guys? Therefore, the question is, these are related party transactions. Will it be at market price? No. You remember the cost sheet? Cost sheet has direct expense plus indirect expense. We have admin overhead, production overhead, selling overhead. Selling overhead includes marketing expense. Adding all this only we find cost per unit. Now, within the group of Tata, do I need selling expense? Fiamma Devils, ITC will sell shampoo and soap to ITC hotels. They will not incur marketing expense for selling within the group. So they will of course sell at lower price. Cost per unit will drop. So related party transactions can be at any price. You don't question why it's at a high price or a low price. That's not your problem, guys. What is your problem? What should you focus on? Follow. It's very simple. What should I focus on? You have to focus only on one thing, guys. Only on one thing. Disclosure. What? So this time I'm going to teach you 2 things, again exam oriented. What to disclose, when to disclose. That means, when to disclose means, like who are the related party transactions? For them only I will disclose. Who are they? So who are the related party transactions and what to disclose? These related party transactions, the relationship between people is classified into 2. Related parties where there is a control, related parties where there is a significant influence. Related parties where there is control, related parties where there is significant influence. Are you able to follow, guys? Control and significant influence. Control is the same definition, similar as Companies Act. Controls more than half of the total voting power, or controls the composition of board of directors, or controls the entity through an agreement or a statute. Fine. Significant influence, we know, test for significant influence more than or equal to 20%, but sometimes I might have more than 20%, but still it's not called as significant influence. Are you following, guys? So usually 20% or more, but sometimes less than 20%. I have only 7%. But if you can prove that you have the ability to influence the or get into the operations and financing decisions of the company, ability to influence, or you're responsible for the operating and financing decisions, then you have significant influence. Fine. What, sir? What should I disclose? So control and significant influence. If somebody is controlling me, disclose the and subsidiary. Holding has 70% in subsidiary. Then I have to disclose that holding has 70% in subsidiary. Are you following, guys? Okay. Even if there are no transactions, sir, for the whole year, between holding and subsidiary, the number of transactions are 0. The number of transactions are 0, guys. Then I can disclose. The number of transactions between holding and subsidiary is 0. Then we can disclose. Are you following, guys? Okay, if the number of transactions are 0 also I should disclose. Even if there are some transactions, I have to disclose. So let me repeat, guys. In control, if one entity is controlling the other entity, you have to disclose whether there are transactions or not. Disclose the fact that somebody is controlling. If there are transactions, disclose what transaction, how much is the transaction, when it took place, how much is paid, how much is receivable, what is the percentage, all of that, percentage of this transaction. So, related party transaction of control, I will disclose irrespective of if there is a amount or no amount involved, irrespective of transaction happened or not. If there is control, I will disclose. Significant influence, on the other hand, disclose only when there is a transaction. Disclose only when there is a transaction. Are you following, guys? You will disclose only when there is a transaction. A transaction of significant influence will be disclosed only when there is a transaction, guys. Otherwise, I don't have to disclose this. Are you following? So, significant influence will be disclosed only when there is a transaction. Otherwise, I will not be disclosing this. I hope you guys are following, watching on YouTube, understanding. Okay. Clear? Only when there is a transaction. So let me repeat. Control means disclose whether there is transaction or not. Significant influence, disclose only when there is a transaction. What to disclose? All of this. So first part is over, guys. I taught you what is control, what significant influence, and what to disclose. Sir, which transaction or who are related parties? That's the most important thing in this standard. So I'm going to draw something for you. There is an entity. That entity is holding, subsidiary, associate, and joint venture are related for the entity. Following, guys, the entity is holding, subsidiary, associate, joint venture. Look at this diagram, it gets over. Let me call this as entity A. Let me call this as what, guys? Entity A. In entity A, there is KMP plus relative, they are related parties for the entity. And in the entity, any other individual has control or significant influence, they are also related party for the entity A. So let me again say, I am entity A, guys. I am entity A. For me, my holding, my subsidiary, my associate, my joint venture. Holding, subsidiary, associate, joint venture for me are my related parties. Next, any KMP and relative of the entity is also related party. Now, important over here in this standard alone, KMP Don't think KMPs as KMP as defined in Companies Act. No, it can even be a watchman. I'm not joking. If it meets the definition of KMP, the definition can be an auto driver, it can be even a lower level employee, it can be anybody. The board of director, top management may not be a KMP. Are you following? I'm not trying to put any individual person down. I'm trying to say anybody can be a KMP if they follow a definition. What's the definition? KMP is a person, very, very important guys, who has authority and responsibility of managing the affairs of the enterprise. Managing the operating decisions, financial decisions, operating enterprise, he has both. It's a single one-line definition. Read that. KMP is somebody as per AS 18 who has both authority and responsibility of planning and managing the affairs of the enterprise. That's it in simple words. Okay. So for an entity, my KMP and relative is related party to the entity. For an entity, any other individual, some random individual has control over me, has significant influence over me, then we are related parties. Sir, okay. Anything else? Yes. We also have entity B. Okay. Entity A and entity B, there is no connection. They are two separate entities. Entity A can be in US, entity B can be in China. But follow, this KMP and this relative is also a KMP and relative in this entity B. Look how beautifully it comes. This KMP and relative is a KMP and relative in entity A and entity B. Then we are related parties. This individual who has control and significance influence in entity A also has control and significant influence in entity B. Then entity A and entity B become related parties. Can you see how beautifully it's defined, guys? How beautiful it's coming. So let me summarize. Who is the related party? They will give some transaction. You have to see who's related to whom. We're going to see in RTP question today. So for an entity, holding, subsidiary, associate, joint venture are related parties. For an entity, KMP and relative are also related parties. For an entity, its individual who has control significant also is related party. For an entity, in some other entity B, this KMP and relative is also KMP relative over here, or this individual has control significance in entity B, then A and B are relatives. This is relative for a company. Sir, what about individuals, sir? You said KMP plus relative. Who is the relative for an individual? Simple. It's not father, brother, mother, no. They are saying, basically it's a very nice definition. As per AS 18 related party definition, Mukesh Ambani and Anil Ambani are not related parties because they don't talk. So they are saying, for an individual, very simple. Parents, father, mother, brother, sister, or fiancé, husband, wife or husband, based on the gender, wife or husband, and the kids, son or daughter. That's it. That's it. They are saying it's the close family, guys. One step above, father, mother, parents. One below, kids, son, daughter, brother, sister, fiancé, spouse. That's it. Only close people. Sir, I have 10 kids. So what? Don't ask questions like this, okay? They don't say son or daughters, okay? Brother, sister, father, mother, wife. They are all related party and they use a beautiful word here, guys. Beautiful word. All these people who may be influenced or will influence me. So if I am the individual, I can influence my father or father can influence my decisions. The father and son are not talking, not related. Individual, are you influencing brother or brother is influencing you? Yes, then relative. No sir, brother and me are having fight, we are not talking, not relative. Are you following, guys? This is next. And lastly, end of the standard. So we have learned what to disclose. Control means disclose whatever happens, whether there is transaction or not. Significant influence, disclose only when there is transaction. Then I showed definition of entity and who are all the related parties. Then we saw who are the relatives for an individual. And last part, we are going to see who is not a related party, or there's also one more question over here. AS 18 not applicable in these cases. Basically, it is exempt, guys. This is a common question. Many times they have asked in exam. When exam they have asked many times. For November 23, you can mark AS 18 as important because they haven't tested for a while. They have not tested for a long time. When AS 18 is not applicable, simple. AS 18 is not applicable just because there is a common director in two companies. If there is a common director in two companies, in company X Limited and company Y Limited, director is, let's say, Mr. A is a director in both companies. Just because I am a director in both companies does not mean X and Y are related parties. You should either be a KMP in both the companies, or you should be KMP in one company, have control or significant influence in other company. Are you following, guys? That's about it. So, common director in both companies not counted. In case of consolidation advance accounts, you know, you do intercompany adjustments. We do intercompany adjustments, correct? Holding subsidiary, bills receivable, bills payable, set off. Why am I not disclosing, sir? You are doing set off. There, consolidation AS 21 is overruling AS 18 and telling, hey, in consolidation, intra-group transactions need not be disclosed. I will set off. Fine. Next, where the disclosure is exempt by law. Law is telling you no need to disclose. For example, Banking Regulation Act. I am the chairman of ICAI Bank. I am a related party. Yes, because I am KMP for ICICI Bank. I am KMP for ICICI Bank. I am related to ICICI Bank. Okay, sir. So what? Now my question over here is, should I disclose my bank account balance with ICICI Bank financials? No. Exempt as per Banking Regulation Act says, even though you are related party to the bank, no need to disclose your transactions with the bank. Even though you are taking loan from bank, no need to disclose. As per Banking Regulation Act. Disclosure by law. They won't test this much. Next, service providers or utility providers or service providers. For the entity, corporation is giving water. For the entity, electricity bill is generated. TNEB gives electricity. All these things are service providers or utility providers for which I am paying water tax, electricity bill, all of that. We are not related parties, even though he is the only person who can do it. Next, sole supplier, sole franchise or sole customer or sole vendor. Are you following, guys? Vendor supplier. So, sole supplier, I am buying all the goods only from one person. Or sole customer, I am buying medicines from many companies but selling it only to Apollo Pharmacy or Apollo Hospitals. If Apollo Hospital cancels my contract, where will I go? Gone. So, sole supplier, sole customer, sole franchisee, my purchase side or sales side, I am dependent majorly on one person, does not mean we are related parties. It looks like a related party, but we are not related parties. Are you following, guys? Clear? And last one, all these trade unions in the company, employees who fight, trade unions, local authority, we are not related parties, even though it may look like the same. Are you following, guys? Okay. So this is with respect to AS 18. These are the things which is not related parties. In exam they might ask. Common director, intercompany adjustments, disclosure is exempt by law, service providers, Sole vendor, sole supplier, sole franchise. Service providers means utility providers, trade unions, local authority, all these, we are not related parties. With this, AS 18 also comes to an end. So what I will do, I will not keep my RTPs for the end. I will do one or two more standards. Then we will go to RTPs and again come back to standards. Okay. Let me do one more standard. We're done with 4, 5, 7, 9, 17, 18 is done. Now we are left with only 19, 20, 22. The massive big standards. And then we have 24, 26, 29. That's it. That's all, guys. So let's try to finish this in the next 1.5 hour, 1 hour, and then spend at least 30-40 minutes for RTP discussions. Now the agenda is, I will do a few more standards and then go to RTP and come back to the balance standards in group 2, guys. So just quickly checking on YouTube. If any of you guys have any doubts over there, I'll take all the doubts in the ending. Okay. Fine. Okay, guys. If you're watching the recording version of it, of course, I can't see your doubts. Okay. I'm going to solve the latest RTP as well, but let me do few more standards. Okay. Now let's come from reverse. 19, 20, 22 is the big massive standards. I will cover this also, but to the extent applicable for exam. There are so many concepts, to the extent possible, at least a few key concepts, at least that's coming in the RTP, I will revise. Okay. Let's come in reverse now. AS 29 is simple, guys. It talks about provisions, contingent liabilities and contingent assets. That's all. They will give a situation and ask you, is it a provision, is it a contingent liability, is it a contingent asset? To give you a quick taste of what is what, provision is like provision for tax, provision for doubtful debts, provision for gratuity. Something that I will definitely incur and definitely I have to pay. Contingent liability, it's not certain, guys. May or may not. Contingent asset I might receive. So provision, since it's definite, I will account by debiting my profit and loss account. Contingent liability, it's definite. See, provision is definitely I am going to pay. But how much I am going to pay only is a doubt. See, provision for gratuity, provision for bonus, provision for tax, I will pay this. How much is an estimate? So debit P&L based on the estimate. Contingent liability, whether you pay or not itself is doubtful. So I will not show in the balance sheet of P&L. I will show in the footnote of balance sheet. Contingent asset. So footnote right below balance sheet and notes. Asset is something that may receive. You may win the case. If you win the case, let me account for it. Now, in life, remember, guys, when your expectations go up for anything, and if you don't get it, you will be disappointed. When you have a lot of expectations in something, and that never happens, we always get disappointed, correct? That is why contingent asset, even though it's something that you may receive, 70% chance I may receive, I will not disclose in my financial statements as income, because if I don't receive, I will be disappointed. Don't create expectation for shareholders. So, contingent assets will not come in financial statements, will not come in footnote. I will disclose only in the director's report. Why director's report? Not many people read that. Unless you are serious, you will not read that 100-page material. So keep it somewhere. If you want, you go and search if there is a contingent asset. I don't want to create expectation. Are you following, guys? So you understood what's provision, contingent liability, contingent asset. Let's look at the definition of provision. 3 key points, what to remember for exam. Account for a provision when provision is an estimate where reliable estimate can be made. There is going to be outflow of resources embodying economic benefits. So basically we're focusing on provision is an estimate, or it's an estimate where reliable estimate can be made. There is going to be outflow of resources embodying economic benefits. If these two are satisfied, yes sir, there is reliable estimate can be made, there is outflow of resources embodying economic benefits, then I will make a provision. I'm focusing on the key points. No reliable estimate can be made, or no outflow of resources embodying economic benefits. So no reliable estimate can be made, or no outflow of resources embodying economic benefits. Then instead of creating a provision, I will create a contingent liability. So provision is an expense where reliable estimate can be made and there will be outflow of resources embodying economic benefits. Keywords, make a provision. No reliable estimate can be made. No outflow of resources, make a contingent liability. Legal case, you are going to lose or not, I don't know. No reliable estimate can be made. Will there be outflow of resources? Depends if I win or lose the case. So I don't know. Therefore, contingent liability. One more definition for contingent liability. In simple, they are saying contingent liability is going to have contingent liabilities where there is going to be a settlement. I'm just giving you hints. Because of some event, such an event can be favorable or unfavorable. So contingent liability may result, better words to write, contingent liability may result in a settlement because of some event which is favorable or unfavorable. However, follow guys, such an event is not wholly in control of the enterprise. Follow guys, contingent liability results to a settlement of some money, outflow of money because of some event that is favorable or unfavorable, not wholly in the control of the enterprise. Sir, what is contingent asset? Contingent asset is not a settlement, it is a realization. That's it. Same definition. I'm giving you key points. Contingent asset results in a realization because of some events which could be favorable or unfavorable and not wholly in control of the enterprise. So basically this standard asks you to classify anything as a provision, anything as a contingent liability, anything as a contingent asset. Provision means account for it. Contingent liability, footnote. Contingent asset, disclose in director's report. I gave you a brief of how to classify. Let me give some common examples that come in exam also, because it's exam oriented. You know what's a provision, guys. Provision for tax, gratuity, bonus, doubtful debts, provision for depreciation. We all know depreciation is a saving. Indirectly, it's a saving. How? Not this discussion, but it's a saving. Okay? Beautiful logic behind that. Next, contingent liability, generally in the question, it will be cases, legal cases. In provisions also, sometimes they will give questions like some company did some activity, for example, restructuring cost. Restructuring cost that I'm going to incur in the future. Imagine oil rig. Have you seen this ocean? Many movies, villain will come or song will come there. Oil rig in the middle of the ocean. Once installed, government will ask you to remove within a few years or 10 years. So the cost of restructuring, removing in the future, I know today itself. So I spend 10 crores to install, 1 crore to remove after 10 years. That 1 crore which I'm going to remove in the future is a future liability. Restructuring cost, account now itself by creating a provision. These are examples of provision in the exam. Contingent liability is usually legal cases what they ask. Paid for legal case, should I account or not? Sometimes they will tell trademark has been infringed by some Sun company. This trademark expense, should I paid for legal fees, what to do? Now, case, if you are going to win legal opinion, I will take it as contingent asset, director's report. If legal opinion feels you may lose, you have to pay compensation, contingent liability. Certainly you have to pay. Only amount I don't know. There is a certain liability. Provision is a liability, but certain don't know what to pay. Then it's a provision. Are you following, guys? So this is provision, contingent liability, contingent asset. We will see at least 1 or 2 RTPs questions. Okay. Next. AS 26, guys. AS 26. Then we'll do AS 24. Then we'll go to RTPs. Along with the RTP, I will teach you 19, 20, 22 key points. Key points, okay. Fine. In AS 26, it's a simple standard. Intangible assets. Again, going to purely focus on exam. We are going to divide the standard discussion into only 3 parts. Few key things that you have to remember. What is an intangible asset? We have a definition. Intangible asset is an identifiable non-monetary asset without physical substance, held for use in production of goods, administration or for, let's say, used by others. For production of goods, rendering of service, or for admin purpose. We are not going to focus on definition much. You know intangible asset. For the mind, you think as patent, goodwill, software. We are going to see some key things. Then we are going to see what is research and development, and then we are going to see how to account for an intangible asset. That's it. First, for an I'm going to focus only on exam, guys. It's 3 hours. We are finishing all AS, so follow. Usually it takes 30 hours. Okay. So in intangible assets, few default things. How we have depreciation for an asset. For intangible asset, we have something called amortization. How we have depreciation for an asset. For intangible assets, we have something called what, guys? Amortization. Now, when it comes to amortization in exam, what to do? Same principles like depreciation, but no method of amortization. Usually SLM method, WDV method, no. Here the method they are saying is use a method which reflects or a systematic manner to account, for benefits, guys. A systematic manner to account for the benefits that you get. Any reasonable manner that can account for the pattern of benefits that are coming. We're going to do a sum in RTP. Next. Second one, what is the residual value for an intangible asset? Nil. What is the residual value of Kingfisher after Vijay Mallya left? Became 0 for airlines. I'm talking about airlines. Okay. So generally, residual value for an intangible asset, if it's not given in question, assume it to be 0. But if you want to argue and tell, no sir, for my intangible asset, residual value is 20 lakhs, 40 lakhs, 50 lakhs, 1 crore, 2 crores, it's fine. You take that. So if you feel your intangible asset has a residual value, give that value. Give that value, whatever you think is the correct answer. So if default, it's like a default setting. Default setting, choose any method which systematically accounts for benefits that comes from the intangible asset usage. Fine. Residual value of intangible asset, default setting is 0. Can I change it? Yes. Can it be 10 lakhs? Yes. Give justification. Then last one, what is the life of an intangible asset? Useful life. I am talking about useful life. Default setting is 10 years as per standard. Default setting is what, guys? 10 years. But can I consider 12 years? Yes. Can I consider 9 years? Yes. It is something you can argue and you can increase it if you can give justification. So this assumption is called rebuttable assumption. That means it's a debatable assumption for useful life. I'm hoping you're following, guys. So amortization, use any method that gives you a reasonable answer, reasonable way of accounting for benefits. Residual value, default 0, can I change? Yes. Useful life, default 10, can I change? Yes. That change gives justification. It's called a rebuttable assumption, that's 0 and 10. These are the key things to remember in sums. Now, when I incur for intangible asset, let's say at the time of building COVID vaccine, or now Elon Musk is building something called Neuralink, or let's say tomorrow you are watching this class, you are going to build one software, or you are going to build some patent software for a mobile app you are going to build. This, all the expense that COVID companies did for vaccination or for Neuralink which Elon Musk incurred, all of this expense, follow guys, should I debit to P&L or should I capitalize in balance sheet? Imagine during COVID, a company is building the COVID vaccine for 2 years. They will have spent 100 plus crores, right? So this money, should I debit my profit and loss account or should I debit my balance sheet is the question. Are you following what I'm saying, guys? Should I debit the P&L account or should I debit the balance sheet? Because after 2 years, after I spend, after 2 years, what will happen? If COVID vaccine is a hit, it's approved, you will get money, everybody will pay for it. Leave COVID vaccine, anything you are building, software, patent, whatever. But after 2 years, if vaccine fails, what to do? I will capitalize only if you can get future economic benefits. Sir, I am not going to get future economic benefits. Then why will I capitalize? Are you following, guys? If I am not going to get future economic benefits, why should I capitalize? Are you following, guys? So it's very simple. Debit the P&L account, or capitalize for developing an intangible asset. For that, they are saying classify the activities in building an intangible asset into research phase or development phase. Again, guys, classify the activities into research and development phase. Any expenditure incurred in the research phase should be debited to profit and loss account. Any expenditure in the development phase should be capitalized. Let me give an example to understand this beautifully, guys, because this is important, okay? Elon Musk is building something called Neuralink for the last 10 plus years, right? What is Neuralink? He's going to put a chip inside my head. I'm not going to do it, but inside our head. What chip I can do? Now Alexa is there, play music, light off, Wi-Fi on, AC on. You say it will work. You can do in the phone, it will work. Now tomorrow I don't have to do everything. I will think AC on, AC will become on. I will think TV on, go to channel 425, TV will go to that channel. Okay. So he wanted to put a chip inside your brain where it transmits the brain signals into the device through a chip. Okay. Very futuristic, sir, but will it actually happen? I saw only in movies. For the past 10 years, he's been trying if this is possible and spending billions of dollars. Should I capitalize or debit to P&L? Because if I capitalize and if the project fails, no income for him. So, recently he got the approval from the US government that this chip can be tested on humans because it was succeeded on monkeys. After killing so many monkeys and testing it, it succeeded. He showed a video where monkey is playing video game through mind. So it took him 10 years for the monkey to do it. For the monkey to play what? Game. So this is, he researched to find out if it's actually possible to do it. Research phase, debit PNL. Now he proved it. He proved a monkey can do it. That means if a monkey can do it, he just has to modify the chip and test on humans and develop that into a viable product that is used by humans and humans will pay for it. Now from today, whatever Elon Musk is incurring to convert the chip into a saleable product, an actual use scenario, this expense what Elon Musk will incur is a development phase expense. To again put it, research is not equal to discovery. Columbus discovered US, America. Now, research means trying to find out something which is not there. Sir, are there aliens? We don't know. They might already be there outside Earth in some other planet. If you find them tomorrow, you did not research and find aliens. You discovered and found something that's already there. COVID vaccine was not there. We researched then found out. Elon Musk Neuralink was never there on Earth. We researched then found out. So anything done to basically to gain new scientific knowledge, anything done to gain new scientific knowledge is called research. So Elon Musk found out, okay, I can do this for the chip. That will be debited to PNL. Once you know that it's possible, so once I know it's technically possible, think of Neuralink guys, technically possible with the current resources available, can I develop? Yes. Will people pay and buy it? Yes. There is going to be future economic benefits. Can I measure the cost reliably? Yes. Cost can be measured reliably. Is it commercially viable? Commercially viable means, sir, with the available technical resources I developed, there is future economic benefits. Cost also can be reliably measured, but will people buy it? Is it a product that people need? Is it commercially viable? And last one, do I have the adequate financial resources to execute? Sir, I want to go to space and take a rocket and travel to next universe. Technically, it's not feasible. You don't have the resource, you don't have the money to do it. So it's not development. So COVID vaccine, once we knew that a vaccine works, we had to develop it. So technically feasible, yes. Resource available, yes. Future economic benefits is there, yes. Cost reliably measured, yes. Commercially viable, that means will people pay for it? Yes. Do I have the financial resource? Yes. If all these conditions are satisfied, then only it's a part of development phase and you will capitalize that respective expense. Are you following, guys? I hope you understood what is research and development phase. Quick last few points, two miscellaneous points in the standard. We have something called intangible items. What do you mean by intangible items? Intangible items are like preliminary expense, marketing expense, advertisement expense. These are not intangible assets. This has to be fully debited to my profit and loss account. Coming to last part in the standard, internally generated intangible assets theory, anything they can ask. I'm going to focus on exam, not telling you logic. There is a logic why we are doing this, but this class is not for logic. If you are internally generating intangible asset, internally generated goodwill, others. If it's an internally generated goodwill, I incurred cost for it for many things. Do not account. Acquired goodwill. In case of consolidation, cost of control, goodwill. In case of amalgamation, purchase method, goodwill. That I can account and show in balance sheet. But internally generated goodwill, Reliance, what is the goodwill of Reliance? Internally generated. I spent a lot of money. No, you should not account in balance sheet. Other intangibly internally generated assets like software, patent, copyrights, trademark will be disclosed in the balance sheet in Schedule 3 under the item intangible assets or intangibles under development in Schedule 3. Do you remember, guys? That is this development phase. Okay. Are you following, guys? So with this, we are also done with what, guys? Done with AS 26. Now moving on to AS 24, which talks about discontinuing operations case. Simple standard, may be important for November 23 because they have never tested, and this standard is very simple, guys. What is a discontinuing operation? We have a definition. I'm going to see the key points in the definition. Biggest definition we have in all standards, and what is not a discontinuing operation. That's it. In question, they will give a scenario. What is a discontinuing operation? What's not a discontinuing operation? We're going to discuss that for 10-15 minutes. Finish the standard, go to RTP questions, and then come back to 19-20-22 exam oriented sums over there. Okay. Simple. What's a discontinuing operation? The definition says, I'll give you the keywords, guys. Discontinuing operation is a component of the enterprise that the entity pursuant to a single plan. One, imagine Tata Motors. I'll give a concept why this is important. Tata Motors has passenger vehicles, commercial vehicles. Sales from passenger vehicles and commercial vehicles put together is 500. Breakup is, let's say, passenger 200, commercial 300. Net profit, let us assume the net profit is 200. From passenger vehicles 50, commercial vehicles 150. Okay. I wanted to sell commercial vehicles outside to somebody else. I wanted to sell it to somebody. Okay, that's good. Sell it off to somebody. No problem, nothing to worry. The minute I decide to sell, can I sell? This is not like selling a pencil. The minute you decide to get married by putting a profile on matrimony website, will the transaction immediately happen, guys? Marriage? No, it takes some time. Correct? Same way, when you decide to sell the commercial vehicles department component, immediately sale won't happen. So, it might take 1 year, 2 years, 3 years. But once the sale happens, my sales will decrease from 500 because commercial vehicles is leaving. My net profit also will decrease. Suddenly, shareholder will be surprised. Hey, what is this? Suddenly it decreased. I will tell, yeah, 3 years back itself, you know, we decided to sell, you didn't know. I didn't know. So, AS24 says, if you decide to sell a component, until you actually sell in the financial statement, you show the net profit breakup as net profit from continuing operation, net profit from discontinuing operation. You show it separately. We will show it separately because I'm communicating to shareholder, hey, see, today net profit is 200, but I'm going to sell this component. Tomorrow net profit will be only 150 after I sell this. Lower your expectation. Why I am selling? Reason, business has grown so big. L&T started off as construction company. L&T also had a cement business 20 years back, 15 years back. They were not able to manage both. So they sold the cement business. The cement business L&T sold today is known as Ultratech Cement. The sale took 8 years. For the 8 years, L&T showed in financial statements net profit from continuing operation, construction, from discontinuing operation, cement business. Following guys, now what is the definition? Discontinuing operation is a component of the enterprise that the entity pursuant to a single plan, one resolution, one decision, decides to do follow. Sell the undertaking by form of demerger, spin-off or hive-off, by demerger or sale, I forgot sale, yeah. Sell the component as a whole, like slum sale, income tax slum sale, like that, full sale or demerger or hive-off or spin-off to enterprise shareholders. So nobody is buying my cycle, sir. Big cycle, nobody is buying. Then I will sell the parts. So if I'm not able to sell the whole business, next is piecemeal manner. In dissolution of partnership, you have piecemeal, the same thing. So piecemeal manner, say selling the assets and then settling liabilities. So it's simple. Discontinuing operation is a component of the enterprise that the entity pursuant to a single plan does the sale, demerger, spin-off or hive-off of the entire component, or it sells the assets in a piecemeal manner and settles the liabilities individually, or cycle is there. Nobody wants to buy the cycle. Parts also nobody wants to buy. So what I will do, throw that cycle on the road and go. That is called termination by abandonment. Follow guys. Discontinuing operation is a component of the enterprise that the entity pursuant to a single plan. Sale or the entire component is sold, demerger, spin-off or hive-off, or the entity's assets are sold in a piecemeal manner and liabilities settled individually, or I terminated by abandonment. This is what component? A component that is representing major line of business or geographical area of operations that is identified separately for financial or operating, financial reporting or operating purpose. So again, let me repeat and give you examples. Discontinuing operation is a component of the enterprise, that the entity pursuant to a single plan, one single plan, decides to sell or do demerger or do spin-off or do hive-off, or nobody is buying my cycle, so sell the parts in a piecemeal manner, sell the assets and settle liabilities, or terminate by abandonment. That is not a small TV in my house. It represents a major line of business or geographical area of operations which is identified separately for financial or operating reporting purposes. Let me give an example to understand this better. Apple has many products. Now let's say Apple's division of, let's say Apple Watch and Apple AirPods, let's call Apple Accessories. That department Apple wants to sell through a single plan, either sell, demerger, spin-off or hive off a separate entity, or piecemeal, sell the parts of the entity, or terminate, leave it, nobody is buying it. Example, that represents major line of business. For Apple AirPods and Apple Watch is a major line of business, accessories or geographical area of operations. I am not stopping the production of AirPods or watch, but I decided from today in entire African countries, I will not sell Apple products. Let's say, or European countries fully, Apple decided not to sell Apple products. So this is not ending of major line of business, but ending of geographical area of operations. So anything that is sold in piecemeal manner or abandoned that represents a major line of business or geographical area of operations identified separately for financial and operating reporting purpose. Financial reporting and operating purpose. What is not a discontinuing operation? Simple standard says, follow, remember for exam, they will give this in exam, shifting of production facilities, then basically there is nothing but cost of relocation, staff training, abruptly stopping products for cost saving, or gradual or evolutionary stopping of a product. Let me explain, guys. With this, AS24 comes to an end. What is not a discontinuing operation as per AS24? Shifting of production facility from one location to another location is not a discontinuing operation. I'm just shifting. Staff training, no. Abruptly stopping. COVID came. Can I continue to manufacture t-shirts and shirts? Who's going to buy? Or can I continue to put flight tickets? So abruptly stopped airline service for 6 months due to COVID. This is not to discontinue, but for a temporary reason, for cost saving. Or gradual or evolutionary stopping of a product. Let's say Lays decided nobody wants to buy the red tomato Lays or salted. So they want to buy only blue or orange. So let me manufacture more of blue, orange and green, and slowly I will reduce salted and tomato flavor and keep it to minimal. Shifting of production facilities for gradual or evolutionary stopping of product. Slowly stopping the production of a product is not a discontinuing operation. So shifting of production facilities, staff training cost, abruptly stopping for cost saving or improving efficiency or productivity, all these are not discontinuing operation. Or gradual or evolutionary stopping, phasing out of a product. The right word is, instead of stopping a product, the word should be gradual or evolutionary phasing out a product is not a discontinuing operation. I hope you are able to follow, guys. Now quickly what we will do, we are going to go to and get RTP, guys. So let's get the RTP done. We are done with this standard also. You can take a breather. We are only having 3 standards left. 2 hours. We have finished all the standards. Let's quickly go see all the RTPs that we have. Okay. So what do we have left now is basically only AS19, AS20, AS22. Of course, I will spend at least 30 to 40 minutes on these standards with the sums. So we go to our RTP questions. Try to solve the last 4 RTPs, guys. Extremely important. I am now doing the November 23 RTP for you guys. It's very, very important to do at least last 3 RTPs or 4 RTPs if you can do. In this class, we try to complete at least 2 of them. Let's go from questions 1 to each. Just for saving of time, instead of me solving in detail, I will just run through the solution, because 3 hours. How will we do 3 to 4 RTPs? We're going to do a lot of RTPs, as many as possible, guys. So one place we will have the questions, the other place we can have the answer. So I can quickly run through for you guys. Okay. We're going to finish at least 2 RTPs is the target. If not, minimum is 1. We will do 1 RTP, go back to 19, 20 and 22 and then weekend. That's it. Perfect, guys. I think you can see the question and the answer. We'll quickly run through to save time. Follow, guys. Look at the question. What's the question? AP, a construction contractor, undertakes the construction of a commercial complex of K Limited. AP submitted 3 separate proposals for each of the 3 units of commercial complex. A single agreement is entered. It doesn't matter if agreement is single or multiple. Parties are same. The agreement lays down value of 3 units, 50 lakhs, 60 lakhs and 75 lakhs. Agreement also lays down completion time for each unit. They are asking whether it's treated as single contract or separate contract. Single contract means combination, otherwise separate. We already discussed when the price is separate and 3 separate proposals. Therefore, there is the ability to accept all the 3 or accept 1 or 2 and reject 1 or 2. You have to do a separate accounting and that will only be our answer. Separate proposal has been made. Each asset is subject to separate negotiation and therefore the cost and revenue of each assets is identified separately. Therefore, this will be segmentation. It's going to be separate. We call it as segmentation of contracts. Fine. Second question. Small question. On December 1st, 2022, GR Construction Company undertook a construction contract for building 45 lakhs. Revenue is 45 lakhs. Company found it has already spent 32.5 lakhs and additional cost is 15.1. What I should do? Current cost is 32.5 lakhs. Estimated cost 15.10. Find the percentage. So look at this. You have to divide current cost is 32.5. It's there here. Divided by total cost, current plus future, 47.60. Our percentage of completion is 68.28. This will be applied on the contract revenue, which is 45. So if you go and see the P&L account over here, I will go and prepare a simple thing. 45 into 68.28 applied percentage, I got 30.73. But what is the cost incurred till date? 32.73. 32.73. Therefore, you have a loss in current year. The minute you see a loss in current year, because this is the revenue of current year, we have loss. I told you, do total contract revenue minus total contract price to find total loss. So if you look at this, total contract revenue is 45, total contract price is 47, sorry, total contract cost is 47. So total loss that I'm going to recognize is 2.60. Current year loss is 2. Estimated loss is 0.60. So total loss of 2.6 will be accounted. Now AS7 is done. Let's go to AS9. Simple question. Goods of 50,000 were sold on 18th March, but at the request of the buyer, it was delivered on 15th April. When will I account revenue? You requested for late delivery, so I kept it, not my fault. So sale will be done only on 18th March itself. So look at this. Case 1, the sale is complete, but delivery has been postponed at whose request? Buyer's request. So BS should recognize the entire sale for that year itself, for the 31st March 2023 year. Are you following, guys? Okay. Next, on 1st April 2023, goods of 1,25,000 are sent on consignment basis, of which 20% of the goods are lying with the consignee. That means 80% will be recorded as sale, because 20% is with consignee, 80% is sold, so 80% is recorded as sale. Next, again sale or return basis. 1 lakh worth of goods were sold on approval basis on 1st December 2022. Okay, the period was 3 months. That means December, Jan, Feb. It should end by Feb. Buyer sent approval for 75% of the goods up to 31st Jan and no approval is received for the balance. So if you see guys, up to 31st Jan, 75% is approved. So 75% I will record as sale. Balance 25% I will wait till 28th Feb because 3 months gets over in 28th Feb. After 28th Feb, I will record as sale. Therefore, as of 31st March, entire 100% full total revenue will be recorded as sale, but at different points during the year. I hope you are following, guys. Simple question. Next, I told you AS17 examiner's favorite question is segment revenue, result and asset. Asset is simple. Total assets given is 150. So look at that. Let's try to actually compute the question itself. So let me do this. So I can open it this way. It becomes easier. Yeah. So if you follow, guys, segment assets, total is 150, 10% is 15. Anything that crosses 15, so segment A, B, C will be recorded, C will not be reported. As per revenue test, total is 1000, 10% is 100. Anything that crosses 100, A, B, C, D, all will be reportable segments. Let's go check. So if you look at this, on the base of revenue, all are reportable segments. On the base of assets, we will test segment assets 10% or more. So from 10% or more, revenue is satisfying all. So I will report everything. On asset, I told you ABC except D are reportable segments. What about result test? Result test, like I told you, take total of profits. What's the total of profit? 45 plus 45 plus 80. 90 plus 80, 160, 170 is my total of profit. Total of loss is 80, 70 plus 10. So my total of loss is 190 plus 170, 170, 10%. Anything which crosses 17, everything except D crosses 17. So in result test also, they will write on the base of result test ABC, the absolute amount more than 125. Sorry, this is total, guys. I mistook total. Leave the total part. So profit is 80 plus 45. Let me just write that down to avoid confusion. The total profit is 80 plus 45, which is 125. A plus C. Total loss is 70 plus 10, which is 80. Which is higher? 125. Anything 10% of 125 is 12.5. Anything equal to or more than 12.5, A, B, C will be accounted and not D. So what matters here is explain what are the tests, explain the computation. That's it. That's it. Now if I go to AS18, related party transactions. Hold on, I'll just try to do something. It becomes easier. Yeah. So I can write with the questions itself. So we can stay on the same document. Remember, guys, not part of a thing, but NBFC is important this time, especially a question like this. Have a look. Yeah, if I go to AS18, this is our question. You have to ask, you have to write what is, who is related to whom. So if you see Maya, Sheetal and Fair, we have to try to draw. So no other option. Maya is having 61% of Sheetal. Sheetal holds 51% of Fair and Care holds 49% of Fair. So Maya 61% of Sheetal, Sheetal holds 51% of Fair and Care holds 49% of Fair. Who is related to whom? Look at each entity individually. For Maya, see everybody. For Maya, Sheetal is related because it's subsidiary. For Maya, Fair is also related, subsidiary of subsidiary. So Maya has two relationships. Maya and Care, there is no relationship at all because nobody is controlling both these entities. So they are not related. Come to Sheetal. For Sheetal, Maya will become holding, and FAR will become subsidiary. Are you following, guys? For FAR, Sheetal will become holding and CAR will become associate company. Associate investing company. For CAR, FAR will be what do you call joint, investing associate company. So look at that same thing. For reporting Maya, we have subsidiary and subsidiary, Sheetal and FAR. For Sheetal, again Maya and FAR. So for Sheetal, if you see, for Sheetal it's Maya and FAR. For Maya it's Sheetal and FAR. That's what is given over here. For reporting entity, first let's finish CAR. For CAR it's simple. For CAR it's only FAR because associate. Associate, it's basically an associate entity, related party. For FAR, if you see, we have two holdings, Maya and Sheetal. Both are holding and ultimate holding. And CAR is the investor, investing party, the other associate over here. So simple, you just draw around. They haven't even gone to the detailed discussion of the definition. Okay. AS 18, that's the kind of questions you can expect. Or the other type of question in AS 18 that comes in exam is one company has two directors, how to account. AS 19, I'll come back to it. We'll finish the other questions. Then again, we'll continue 19, 20 and 22. AS 19, 20, I will do these two sums for sure. 22, deferred tax. Then they have not asked AS 24, find intangible assets. They have given a simple thing that asset is costing 600 lakhs. These are the cash flows for the next 5 years. After the third year, it was estimated that the patents would have an estimated balance future life of 3 years, and Swift Limited expected the estimated cash flow after 5th year to be 75 lakhs. Are you following, guys? So they are saying after 3 years, we are expecting one more year and the last year cash is 75 lakhs. Compute the amortization. So if I have to quickly compute this, year 1, year 2, year 3, year 4, year 5 was the initial plan, and later it was figured out. I have even year 6. When I figured this out, I figured a year 6 is there only at the end of year 3. What is the cash flows? 300, 300, 300, 150, 150, and last year is 75. Initially, I thought only 5 years. So my asset of 600 will be apportioned in the ratio of 300 is to 300 is to 300 is to 150 is to 150. I am apportioning my intangible asset of patent. For the first 2 years, no problem, because first 2 years my estimate is only 5 years. So if you look at the solution over here, for the first 3 years, we would have done just like that normally in the apportionment ratio of 300, 300, 300. So 150, 150, 150. Only in the third year ending, look at that, they said at the estimated after third year. So after 3 years, so basically for the first 3 years, you have to apportion 600 in the ratio of 3 is to 3 is to 3 is to 1.5 is to 1.5. So if you multiply 600 into 3 divided by 3, 6, 9, 12, which is 1 by 4, you will get 150, correct? That's what we got, 150 over here for the first 3 years. But for the last 3 years, the ratio changed. So how much is already apportioned? 450 is apportioned. So out of 600, if I remove 450, I am left with 150. But when I am left with 150, the future cash flows are now 150, 150, 75. Extend by one more year. So this 150, I will now apportion in my new ratio of 15 is to 15 is to 7.5. So it will be 150 into 15 by 30 plus 7.5, 47.5. So you will get 60. Then this 30, how it came? 150 into 75 divided by 375. 150, 300, 375 divided by 375 is the base. In the ratio of 150 is to 150 is to 75. So you got 30. Following, guys. That's what is that. Which is 150 is to 150 75 is 2 is to 2 is to 1. In the year 456, show the breakup and then we are done. Last question, AS29 and then standards in this RTP comes to an end. You are required to compute provision or contingent liability or contingent asset. Let's read and see. The company operates an offshore oil field, exact oil rig, what we are talking about, where its licensing agreement requires it to remove the oil rig at the end of the production and restore the seabed. 85% of the eventual cost relate to removal. That means after keeping the oil rig already installed, they are saying 85% of the cost is to remove the oil rig. Okay. And the balance 15% is for extraction of the oil. The cost, the working capital to extract the oil from the sea and spoil the earth. Rig has been constructed, but no oil has been extracted. Now, is this a provision, contingent liability or contingent asset? Rig has already been installed. See, rig has been constructed. Now, whether you extract oil or not, you have to remove the rig. Therefore, 85% of the cost which is incurred has to be removed, which is a restructuring cost for which I will create a provision. The balance 15% I will incur only if I extract oil. Since so far no extraction is done, I will not account for it. So answer is 85% create a provision, 15% no need. Let's look at next question and then directly go see the answers. Government introduced a number of changes in taxation laws. As a result of these changes, company will need to train a large portion of its accounting and legal workforce in order to for continued compliance with tax regulation. No staff, as of balance sheet date, no retraining, no staff training has been done. So why will I create provision? Let's go look at the answer. This is oil rig. The answer is 85%. These costs are included as part of the rig restoration. Included restructuring cost as per AS10, we will include an asset value, so we will keep depreciating. That means it's included in accounting. Balance 15% through our, you have to account as liability only when the oil is extracted. Since there is no extraction, you no need to account for this. Last one, if you look at this, the expenditure of training staff relates to the future contract, but I will definitely incur, but there are no liabilities for restructuring as on balance sheet date. Such expenditure are recognized on the same basis if they arose independently of a restructuring. As at the balance sheet date, no expenditure incurred, so no provision has to be created. We are talking about restructuring cost is recognized only when the criteria for provisions are met. Here, staff training cost, the answer is not there in RTP. This, they've answered basically for the first thing itself twice, guys. This entire answer is for restructuring. Okay. For the government staff training, no training has taken place, but government introduced law, so we have to train. There is going to be a future outflow. There is going to be a liability. I'm definitely going to incur. So I will create a provision for that. With this, RTP November 23 comes to an end subject to AS 20, 19 and 22. Let me first discuss these concepts limited for our exam. Okay. Follow, guys, just checking if there is any doubts you guys have. Fine. There are not many. I am not able to see the doubts, but fine. It's okay. Okay. Follow, guys. Now follow. Next one. Simple one. I'm going to take AS 20 earnings per share. We all know the formula of earnings per share is net profit after tax minus preference dividend, if any. If it is cumulative preference dividend, you have to minus the preference dividend. If it's cumulative preference dividend, you have to minus the preference dividend, whether question says or not, if the word cumulative is given. In other words, this is called net profit available for equity shareholders, divided by something called Vains. I am not getting into logic of how Vains is computed. Weighted average number of equity shares. Remember guys, AS 19, 20, 22 alone in a normal class, it's taken by me for 10 hours. Here we are trying to do it in 30 to 45 minutes. So I'm focusing on what sum we have, what is relevant for exam. So net profit after tax minus preference dividend divided by Vains. Why we are doing Vains is to find weighted average number of shares. So shares outstanding into period. In this, if it is basically normal basic EPS, that's the above formula. Here we have scenarios like bonus, stock split, consolidation of shares. For all of this, answer is simple. It's very easy. Report EPS as if bonus is given in the previous year. Report EPS as if bonus is given in the beginning of the reporting period. Then we have rights and buyback, and then we also have diluted EPS. I am not discussing about diluted EPS over here. We are focusing on the sum which is in the RTP over here. Okay. Now, if you look at rights, just to give you a logic as to why we do this. Okay. If rights are issued in the middle of the year, second half of the year, we have old shares plus rights. In beginning of the year, we have only old shares. So to give you a small logic here, assume beginning of the year I have 50,000 shares, or let's say 1 lakh shares. Middle of the year I issued 50,000 shares at rupees 40 per share. End of the year I have 50,000 shares. Normally how do I compute Vains? 1 lakh into 6 by 12, middle of the year assume 6 months, done. So end of the year 1,50,000 into 6 by 12. So first 6 months, next 6 months, finish, proceed. But look at the problem here. The amount we raise this 50,000 into 40, which is 20 lakhs. Rights issue generally, will it happen at market price or less than market price? It usually happens only at less than market price, at a discount for shareholders. Because I gave it discount, assume the market price is here 50 rupees. Okay. So if the same 20 lakhs was raised from public at 50 rupees per share, all I had to issue was 40,000 shares. So if my fund requirement is 20 lakhs, where in the public I could have raised 40,000 shares into 50, you ended up raising 50,000 shares into 40, because there is an element of discount. That means something is given for free, or can I just say there is some element of bonus in the rights issue. So when I summarize, the second half of the year where there is rights issue, such a right issue in second half of the year is inclusive of bonus. Just know it. What is the bonus, sir? Where I was supposed to give 50,000 shares at 40, I gave 40 at 50. The first half of the year doesn't include bonus. And in EPS, in bonus issue, you know very easily, whenever company makes bonus issue, account as if the bonus issue is made at the beginning of the reporting period. So what you have to do is assume as if that rights is there from the beginning of the year. So our steps are very simple. Step 1, they ask you to compute. This formula and steps has an amazing logic for each step, which takes 30 to 40 minutes for me to explain. We are in a marathon now where exam is important, not the logic of steps. Okay, logic makes it easy, but given the time, focusing only on steps for exam. First step is to find something called theoretical X rights price. That means what is the price of share after issue. So if you go to above question, how many shares were there before rights issue? 1 lakh shares. So before rights issue, we had 1 lakh shares in the above illustration I gave. Each share is priced at how much? 50. Rights issue, how many new shares are issued? 40,000. At what price? 50. So now my total portfolio will become, before rights issue, 1 lakh shares into 50. Now in rights issue, 40,000 into 50. How many shares I have? Earlier 1 lakh, now plus new 40,000. This only is the formula, guys. Existing number of shares into market price before rights, called cum rights price, plus new number of shares, rights shares issued 40,000 into price per share, into price of per share of rights issue. This should be 40, sorry, rights issue price. Okay, rights issue price. The number of shares issued, I'm so sorry. Okay, number of shares issued for rights is 50,000 into 40. If you recognize this mistake, that's good. So existing number of shares I had is 1 lakh into 50 plus what is the rights issue I gave? I gave 50,000 shares at price of 40, totally 1 lakh plus 50,000. So my formula will be existing number of shares into market price before rights, cum right price plus rights issue, shares issued in rights into price per right issue divided by existing number of shares plus new number of shares. Are you following, guys? This is my theoretical X right price. Compute this as first step. Second step will basically be, fair value before rights divided by theoretical X rights price. In our example, fair value was 50. Price before issue was 50 in this case. If I divide all this, my answer should be somewhat around, let's say, 47 roughly. So divide by theoretical X right price. Then you will get some answer, let's say 1.05 for example. Okay. Then my third step will be opening number of shares. In the example I gave, opening number of shares is 1 lakh into step 2 answer, which is 1.05. Opening number of shares into theoretical X right price. Step 4 will be this into this. You will get, let's say, 1.05 lakh shares, whatever, 1 lakh 5,000. This will be the shares after adjustment for rights. So on this, I will compute veins. So instead of multiplying in our example, instead of multiplying 1 lakh into 6 by 12, I will do 1 lakh 5,000 into 6 by 12 and then finish the sum. So let's quickly do this sum, guys. I did one sum, again one more sum in RTP. Net profit for previous year 30 lakhs, current year 50 lakhs. Number of shares outstanding prior to rights is 20 lakhs. Rights issue price 20. Last date to exchange 1st June. Date in rights issue is not relevant because I'm going to go to the as if issue is made in first day itself. Only for veins I need that period. This is financial year. So 1st June means April, May. 2 months is before rights. Rights is 1 for every 5 shares. There are 4 lakh new equity shares because 20 lakh. Even if they don't give this, 20 lakh into 1 by 5, you will get 4 lakhs. Fair value of rights before market price before issue is 26. How do I compute? Very simple. I told you steps. Step 1 is computation of theoretical X right price. That big formula I told. It's simple, guys. What is the formula? Number of shares before rights issue is 20 lakhs. Tick. What is the price before rights issue in the question? 26. Tick. Then how many rights shares? 4 lakhs into rights issue price 20 divided by existing shares and new shares. Then you divide, you will get 25. Now you divide rights issue price before by this theoretical 26 by 25. So we do 26 by 25, you get 1.04. Apply this 1.04 on the opening number of shares. Opening, how many shares we have? Beginning of the year we have 20 lakh shares into 1.04. Okay, so how you will divide that? Restated for rights. First, originally without rights is simple. See, without rights is 30 lakhs divided by 20 lakhs equity shares 1.5. Now with rights it will be 30 lakhs but divided by follow guys. Look at the breakup over here. This is the one. I'm focusing on this part. 20 lakhs into 1.04 with rights issue into 2 by 12 first 2 months. Second half of the year 24 lakhs into 10 by 12, you will get 50 lakhs by 23 lakh 46,667, you get 2.31. This is for the current year 17-18. In the year where rights are issued, it is for that year. What about the previous year? Previous year rights were never issued. So I told you, in case of bonus, what do we do? In bonus, we do a simple thing. Account as if rights are, bonus is issued from the beginning of the reporting period. So I will assume rights or bonus is made on 1st April 2016 itself. So what is that bonus element here? 1.04 per share. So I will do 20 lakhs into 1.04 into 12 by 12. This is for previous year. That's why 20 lakhs into 1.04 for the previous year. For the previous year, bonus is included for the whole period of previous year. No need to do into 2 by 12. So 20 lakhs into 1.04, numerator 30 lakhs, you will get 1.44. This is how you compute for rights issue. I hope in this time you are able to understand guys. Quickly, just to give you a breather about what is diluted EPS. Okay, very simple guys. Diluted EPS can come because of 3 things. What is diluted EPS? Imagine in my balance sheet, I have equity shares, 10 lakh shares. I have equity shares, 10 lakhs. And then I have 10% debentures, 1 lakh, 10,000 into, let's say, 10. Okay. This debentures will be converted to equity shares sometime in the future. This debentures will be converted to equity shares sometime in the future. So when this conversion happens sometime in the future, my numerator net profit also will change. For example, for debentures, 10 lakh into 1 lakh is interest of 10,000 I will pay. 1 lakh into 10%. If debentures are converted to equity shares, I don't have to pay interest. So my net profit will increase. Similarly, my denominator also, assume there are 10 lakh shares into 1 lakh shares into 10. Existing I have 1 lakh shares. Now additionally new 10,000 equity shares are coming. Imagine I give you a cake of 5 kg and ask 50 of you to share. Sir, 50 people 5 kg cake, only little will get. Okay, I'm okay sir, 5 kg cake for 50 people. Now if I tell, sorry, 100 of you share this 5 kg cake, will you agree? You will be disappointed. So earlier this was my net profit which is shared by existing equity shares. But in the future, I'm going to get new equity shares because of convertible debentures. Don't ask me why new future equity shares. For issuing convertible debentures, you only pass resolution, special resolution. So since I'm getting new equity shareholders, my net profit also will increase, but not significantly, only to the extent of the interest that is saved. So I have to tell, hey look, in the future, our shareholders are going to increase for this much of profits. Therefore, what is going to be the diluted EPS? Future EPS is going to decrease. Therefore, what is going to be the decrease? So important things to note over here is report diluted EPS only if the EPS is going to decrease. Report diluted EPS only if the EPS is going to decrease. If EPS is going to increase, don't disclose anything. So, our dilution can happen because of three things, guys. Dilution can happen because of three things: convertible debentures, convertible preference shares, options. I am going to focus on what to do with numerator and denominator in each case. Denominator in debentures, add new equity shares. In preference shares also add new equity shares. Easy. They will give conversion ratio. Every preference share is going to be converted to 4 preference shares, or every debenture is going to be converted to, every 4 debentures to be converted to 1 equity share. Something. Add new equity shares. Easy. Debentures, if you look at the numerator, because of debentures being converted to equity shares, I don't have to pay interest. I don't have to pay interest, guys. So I will add back interest. But since interest is not paid, net profit will increase. So if net profit increases, tax also will increase. How much is the extra tax? Tax rate on interest. That's why the formula is very simple. Our formula is pretty simple, guys. What the formula says is, your numerator over here will be existing net profit plus interest saved plus tax on interest, but that will be in brackets. So it's a minus tax on interest. In other words, it is existing net profit plus 1 minus tax rate of interest, guys. So it's existing net profit plus interest saved minus tax on interest saved. So if you are saving interest of 10,000, your profit also is increasing by 10,000, but you have to pay additional 3,000 tax if tax rate is 30%. So my net increase is only 7,000. Are you following, guys? I can show with numbers, logic, but we are trying to finish in 3 hours maximum possible. Come to preference shares. In preference shares also, it is going to be simple. Existing net profit plus dividend saved plus dividend distribution tax, or we call it as corporate tax. So simple, guys. Existing net profit plus dividend saved plus dividend distribution tax. Here no minus. Logic and all I will tell you in a different class, but for you to understand quickly, logic, because dividend comes after tax, interest comes before tax. If you are able to understand, dividend is after tax, so no concept of tax saved here. So for preference shares, increase in new equity in denominator, existing net profit on top plus dividend saved plus dividend distribution tax saved. For options, basically consider whatever is given for free. Numerator is always 0, guys. So first add options in the question. Always first add options. Numerator is always 0, 0, 0. Why is it 0? Because of options, there is no increase in net profit. Only cash flow can come. Then how to compute options? They might tell company is giving 60,000 options to employees. A share which is worth 75, I am giving at 60 rupees. What is the discount alone I will add? So, if you see, 60,000 options worth 75 is given for 60. So, what I will do 60,000 into 60. How much you are paying divided by 75. I will end up with some answer. Or in other words, what is the amount of discount given? What is the amount of free options which are given? That only will be added in the denominator in options. See, if I split this options, some part is paid, some part is free. In denominator, if you add the paid part at fair value, numerator you can't add anything because I don't know the impact of profit on this. So entire thing is ignored. Whatever they paid for is ignored. Whatever is the free part is added because of free part, like bonus, numerator also net profit, no increase or decrease. Denominator, we will have a change. Sir, I don't want logic, sir. I'm also sorry for telling you logic because this is not the time to tell you logic. Exam, what to do? Simple. You compute, in this case, number of options. What is the price paid? X. Okay, this is the amount paid for all the options which are given. This divided by what is the fair value of each option? 75. Are you following, guys? So now if you divide 60,000 into 60 divided by 75, we will get 60,000 into 60 will be 36 lakhs is the money I am receiving. But if this money public paid divided by 75, you will get 48,000 options. So I am issuing 60,000 options in a place where I should issue 48,000 options. So what is the options given for free? 12,000. So this 12,000 free options only I will add in my denominator for options. Are you following, guys? This is with respect to AS20, we are done. Now I'm going to go to AS22, deferred tax, accounting for deferred tax. So follow, guys. We are going to go to deferred tax now. Okay. What is deferred tax? A pretty complicated standard. People find it difficult, but nothing for you to worry. I can teach this standard with logic and making you understand what is deferred tax and liability, but we don't have that time. I need to score in exam. So I'm going to give you an amazing shortcut which you have never heard of, or if you know, that's good. For exam viewpoint, I need marks, sir. What to do? It's a logic, guys. I need 1 hour just for logic, but today is not for logic, it's for exam. So you compute two things: accounting profit, tax profit. I am teaching you shortcut for the exam which will always work for any sum. Easily it will work. You compute accounting profit and tax profit. Compute what, guys? Accounting and tax profit. More often than not, 9 out of 10 times, this will be given in the question. This will be given in the question. I need to score in exam, right? This will be given in the question. Always, just for this shortcut, accounting profit is wrong, tax profit is correct. Accounting profit is wrong, tax profit is correct. Let me say accounting profit is given as 7 lakhs, tax rate is 50%, and assume tax profit is 9 lakhs. So, which is correct, guys? Tax profit is correct. Tax profit is correct. Accounting profit, tax is correct. Accounting is wrong. So, always in life, from wrong, this is default for shortcut. Accounting is wrong, tax is correct. And remember, deferred tax, always accounting happens in accounting books. That means it happens here. And remember one more thing for deferred tax. I am trying to summarize this standard in 10 minutes for you. Remember one more thing. In deferred tax, there is no concept of a tax paid or tax received. It is not any liability paid or money received, guys. We are not paying anything or receiving anything. Are you following? I hope you are following. You are not paying anything. You are not receiving anything. Understand that very clearly. Then what am I doing? I am not paying, I am not receiving. I am only doing one thing. I am only going to do one thing, guys. I'm not paying, I'm not receiving. It's an accounting book entry. I repeated 5 times because it's a book entry. Remember, people think liability means deferred tax liability, am I paying? No. Deferred asset, am I receiving? No. It's only a book entry for better presentation. Okay. So that book entry should be passed only in accounting books. Now come to shortcut. The shortcut is simple. If accounting profit is 7 lakhs, tax profit is 9 lakhs, which is correct? Tax. This tax is correct. Tax is correct. Left hand, I'm wearing watch. Assume this is tax. Tax is correct. Accounting is wrong. Accounting is wrong. From the wrong profit, I have to go to the correct profit. From the wrong profit, I have to go to the correct profit. From wrong, I have to go to the correct profit. Shortcut, follow. So, from 7 lakhs, I have to go to 9 lakhs. From 7 lakhs, I have to go to 9 lakhs. So, in my trading and P&L account, profit given is 7 lakhs. I have to make it 9 lakhs. So, what I should do? Credit my P&L. How to increase profit? From accounting, I have to go to tax, means I have to credit my P&L. So, if I'm crediting P&L, what to debit? Deferred tax asset. Are you following, guys? What is the amount? Difference is 2 lakhs into tax rate 50%. So, the answer is 1 lakh. 1 lakh will be my deferred tax asset. Are you following, guys? Opposite. It works for all sums. Try it out. We will do for 2 sums at least. Tax profit. Okay. Accounting profit is 4 lakhs. Tax profit is 1 lakh. Which is correct? Tax is correct. It's only 1 lakh. Which is wrong? Accounting is wrong. 4 lakhs. From accounting, I have to come to tax. I have to reduce my profit in my trading P&L account. So, I will debit my P&L account. Since I am debiting P&L, I will credit deferred tax liability. How much, sir? Difference is how much? 3 lakhs into 50%. 1.50 lakhs is my deferred tax liability. Okay. Now, few important things to note. 1. This deferred tax liability or deferred tax asset will be created only in the year where a new transaction is occurring. Follow, guys. Deferred tax asset or liability will be created only in the year where a new transaction is coming. In the next year, the deferred tax liability asset created gets reversed. That is 1. And this deferred tax liability or different asset liability comes because we have a difference. Such a difference is called timing difference, and such a difference can be permanent or temporary timing difference. What are the difference called, guys? Permanent or temporary timing difference. For example, some exemptions given, tax exemptions. These tax exemptions is a permanent tax saving. A difference which is permanent, remains forever. No need to create deferred tax asset or liability. Timing difference which is temporary, depreciation, those kind of things is temporary timing difference. I have to create DTA or DTL. What is timing difference? You need to know the concept, guys, now. So, with this background, there are 2 type of sums they can ask in exam. MAT sum or tax holiday sum. That's it. MAT or tax holiday. Tax holiday means in a period there will be a sub period where the tax is 0. So, for that period of holiday, the difference which is created here, or reversed over here, no need to create DTA or DTL. That's all. Tax holiday means any difference originating or reversing in tax holiday period. No need to create DTA or DTL. Sir, what to do with MAT? If something is in MAT, we have 3 profits: book profits, as per Companies Act, you have tax profit, you have profit as per MAT. Do the sum of MAT as if MAT is not there in the question. Let me show you. Sir, I want to know exam. See, deferred tax is 3 hours concept. I am trying to give you discussion which is relevant for our MCQ, RTP sum at least. Question 18. So let me go to 18, guys. This simple sum, guys. Aditya Limited, we have to compute deferred tax asset or liability. Simple. Let's go with shortcut. Forget the logic. We are in marathon for exam. Okay. Two profits, accounting profit and profit as per, they have three things here. Accounting profit, profit as per MAT, as per income tax. I told you, in any sum, whether MAT is there or not, I have to compare only accounting and PGBP, income tax. This MAT, as if it is not there, do the comparison. Accounting is 15 lakhs. So accounting is 15 lakhs. Tax is only 2.5. Tax is only 2.5 lakhs, guys. Accounting is 15. Which is correct? Tax is correct. Which is wrong? Accounting is wrong. From wrong, I have to come to correct. From wrong, I have to come to correct. From wrong, I have to come to correct. So I have to reduce. Therefore, I will debit my P&L account. So I will credit what? Deferred tax liability, because I am reducing. To what extent? What's the difference? 15 lakhs minus 2.5 lakhs, what's the difference, guys? 12 lakh 50,000 into, don't see MAT rate. What's the tax rate? 20%. So into 20% will be 12 lakhs to 20% will give me an answer of 2 lakh 50,000. So my answer is P&L account to deferred tax liability 2 lakh 50. This is the shortcut. This whole discussion of today's class is for you to understand the shortcut. You understood the shortcut? Look at the answer. Deferred tax liability 2 lakh 50. Are you following, guys? But how they will do in exam? Tax as per accounting profit. 50 lakhs into 20%. 3 lakhs. Because the rate is 20. Again tax as per income tax. 2 lakh 50 and 20%. 50,000. Tax as per MAT. 7 lakh 50 7.5. 56. 250. Therefore, total tax liability, tax expense, what I am going to pay to government here will be basically 56 250. Correct? So what they are doing, there is an equation which says tax expense is current tax plus deferred tax. Mug up that. For exam, I don't like people mugging up without logic, but we are going in a marathon here to understand for exam. So tax expense is current plus deferred tax. Tax expense as per accounts is 3 lakhs. Current tax is 50,000. Deferred tax is balancing figure. So deferred tax is 3 lakh minus 50, 2 lakh 50,000. That's it. For shortcut, for exam purpose, presentation. Understood our logic, guys? We did this like this method. Are you following? Okay. So this is with respect to AS 22 deferred tax. Let me actually try to do one more sum, at least for AS 22 for your satisfaction. At least let me do sums, because logic we don't have so much time, guys. Follow. 3 hours is the target. In 3 hours we are trying to finish. Look at this. Again segment reporting is done. Okay. Again rights issue came. Important. Market. Discontinuing operations, let me do. They have not given AS 22 question here. Let me do discontinuing operation. Important for our exam. Now follow, guys. Except AS 19, 20 and 22, all the other standards have covered everything in this 3 hours. So you don't have to worry. These 3 standards, AS 20 also writes and WDPS theory is done. Theory is over. Sums you have to practice. 22 I am doing only those sums and related concepts of RTP, last 2-3 RTPs. 19 we will get there. Okay. 19 last we will keep it ending easy. Now look at this sum. Discontinuing operation. I told you gradual or evolutionary phasing out is not a discontinuing operation. If you look at this, the number of dishwash and clothes washing was 2 lakhs in both. then 1, 2 became 1, 2 became 3, then 1 became 0, the 2 lakhs of clothes washing bar became 4 lakhs. They're asking, is this discontinuing operation? Answer is no, because gradual or evolutionary phasing out of a product is not a discontinuing operation. Let me try and find RTP May 23 only we saw note. I am looking for questions from deferred tax just to do one more sum if we find it here, otherwise just at least 1 to RTP sums. Here they have asked, you just define the following: accounting income loss, we know. Taxable income, tax loss is basically set off carry forward. Tax expense is a tax saving, because expense allowed in tax is a tax saving, nothing much. Look at diluted EPS here, fairly simple guys. They gave net profit for their number of equity shares, debentures that are going to be converted, tax rate. Easily we can go look at the answer and understand. Existing plus savings, if you compute, let's go look straight to the answer. 18. So if you see here, first basic EPS is computed as 37,50,000 divided by 5 lakh 7.5. That is basic EPS. Diluted EPS is very easy, guys. If you look at this, existing earnings is 37,50,000. Add interest of current year 4 lakhs. Less tax saved on interest, I told you, 30% into 4 lakhs minus adjusted net profit. Diluted earnings is 40 lakh 30,000. Number of shares already given is 55. Conversion plus 55,000. So new diluted conversion is 5 lakh 55. Diluted earnings is 40 lakh 30 divided by 5.5, 7.26. What is basic EPS? 7.5. Now 7.26. Therefore, EPS is decreasing. Therefore, we will call it as diluted EPS. If EPS is increasing, it is not diluted EPS. You should not report. If EPS is increasing in diluted EPS, do not report. Are you following, guys? Understanding? Hello? Now, next one, follow in EPS. Sir, what if I have loss? Numerator is a net profit and loss divided by number of shares. Can I divide? Yes. EPS can be negative also. Diluted EPS negative means loss should increase. So if basic EPS is negative 5, diluted EPS will be negative 7. You can report. If basic EPS is negative 5 and if diluted EPS is negative 3, don't report, because it's a gain for me. Never tested a concept like this. They might test in exam. So with this, we are done with standards. Let's see if we can find just in the last RTP available here. I'm trying to do all RTP questions for deferred tax so that at least few sums are done. Study mat you will anyway be knowing. I just hope the tax holiday question is there here. Let's take that, guys. No, this is a different question. So fairly simple. Tax rate is 30%. Items disallowed in 1920, allowed in tax purpose. This would have already been allowed in accounts. Interest to financial institutions in accounting books on accrual basis, but actual payment in tax books 20 lakhs. Donations to private trust not allowed under income tax law. Now, because of these three transactions, you plot these three transactions, guys. Your accounting profits and tax profit will change. So if you go down, question for AS 22, let's look at the answer. Shortcut will work in any sum. Once you find accounting and tax profit. Okay. So if I go here, last sum, let's do it in this. Okay, they are only asking us impact. So, if you look at this, disallowance as per IT Act of earlier years, interest to financial institution. If you see, it is the first one. If you see, yeah, okay. Three things. First, tax payable for earlier year was higher. Disallowance as per IT Act. So, if IT Act we have disallowed, tax profit will be high. Accounting profit will be low. So, since accounting profit is low, look at this guys. Disallowance as per IT Act. So, disallowance as per IT Act means tax profit would have been high. Accounting profit would have been low. So, from accounting profit I have to go up. So, if I have to go up, I have to credit my P&L. Crediting my P&L is debiting what? Deferred tax asset. So, first case, deferred tax asset. Are you following guys? Second case, interest on financial institution allowed as per 43B. If you pay before due date, in both cases if it is allowed, tax and accounting profit will be same. Therefore, not applicable, no impact, no difference. But if it is not allowed in income tax, it will be high. In books, it will be low. Again, I have to increase, then deferred tax. Here it is allowed because it's paid before due date. So, both profits are same, so not applicable. Last, donation to private trust. In income tax, it is disallowed. So, income tax profit is high. In books, it is allowed, so it's low. There is a difference, but this difference, donation, is a disallowance forever. It will always be a disallowance. Therefore, this difference will remain forever, which is a permanent difference. So, no need to create DTA or DTL. That's what is given here. Following guys, okay. So, for AS 22 alone, I have taught you the shortcut and we have done a few sums. Also do a sum of tax holiday. That's the only thing left. Tax holiday is basically the period in which no tax is to be payable. For that period alone, no need to create DTA or DTL. So, with this I will close deferred tax. Limited discussion to the last 4 RTPs only is done. Okay. Now, last one, AS 19. Let's do a few important things over here. AS 19, with that we can do one sum, understand few basics and close. AS 19, I am going to focus my discussion just for you to know some familiar basic terms. Okay. AS 19 is classified into finance lease, operating lease. Follow guys. Let's say we have Zomato and we have, let's say, Arun as an employee of Zomato, and Zomato has taken a car from Hyundai for Arun to use. With the example, I'll try to explain all the terms for you. Okay. Zomato took a car from Hyundai on lease. Assume the car today, if Zomato is going to buy, they will have to pay only 5 lakhs. But they took the car on lease for Arun for 3 years, where they have to pay 2 lakhs plus 2 lakhs plus 2 lakhs. Okay. Following guys. So, who is the person who took the car on lease? Zomato. He is known as lessee. Who gave the car on lease? Hyundai. He is known as lessor. What is the fair value of the asset? 5 lakhs. Why? Because today if I pay for this asset, I will get how much guys? 5 lakh rupees. I am limiting only for our sum. So today if I pay, I will get 5 lakhs. Zomato will be paying to Hyundai every year 2 lakhs, 2 lakhs, 2 lakhs. Correct? So, we understood the basic term lessor, we understood the basic term lessee. Are you following guys? Now, lessor and lessee is clear. At the end of the lease period, what Zomato is going to do, they are going to pay 2 lakhs plus 2 lakhs plus 2 lakhs. But are they going to buy the car? they will buy the car. So assume the last lease payment is a small amount of 10,000. Generally, if you see, this is rent to use the car. But 10,000, Sale of Goods Act says for transferring ownership, there has to be consideration. So just assume for our example, Zomato is paying 2 lakhs plus 2 lakhs plus 2 lakhs, but an optional 10,000 if they want to buy the car and get the ownership. If they want to buy and get the ownership. If they don't buy the car and get ownership, Hyundai will get the car back and they will sell in the market. Assume residual value is 50,000. This is the transaction. What's the transaction? Zomato took a car on lease from Hyundai for 3 years where they are paying 2 lakhs, 2 lakhs and 2 lakhs in each of these 3 years. If they purchase today, they would have paid only 5 lakhs. End of the lease period, optional to pay 10,000 to buy the car. If they pay 10,000, Zomato will get the ownership. If they don't pay 10,000, Hyundai will get the car back and they will sell for 50,000. Now, what is the residual value of the car? 50,000. The lessor, Hyundai, from Hyundai's viewpoint, how much of that residual value they will definitely get? 10,000. Because if Zomato is not paying 10,000, I will sell and get 50,000. But if Zomato is paying 10,000, I will definitely get 10,000. So, we classify residual value as guaranteed residual value, unguaranteed residual value. This standard is all about terms. I am trying to make you familiar with the terms. With one example, then you can see sums. So, residual value is classified as guaranteed residual value and unguaranteed residual value. In our example, residual value is 50, GRV is 10,000, UGRV is 40,000. Who pays GRV? Lessee. Who gets UGRV? Lessor if lessee is not paying GRV. Are you following, guys? Only if Zomato is not paying 10,000 UGRV, then Hyundai lessor will get full amount of UGRV and GRV. So residual value 50 is broken down as 10 plus 40, which is GRV plus UGRV. So what are the terms we learned, guys? We learned 3 terms: lessor, lessee, and we learned residual value GRV, UGRV and RV. Fine. And we also learned fair value. So 3 buckets: lessor and lessee. Money, if you pay today and buy the asset, fair value of the asset. Money paid at the time of end of the asset. If lessee pays, he gets a discount in paying in residual value 10,000 GRV. If he is not paying, Hyundai will sell it and earn residual value. So that component of residual value which he will definitely get is 10,000 GRV. That component that he will not get is 40,000 UGRV. Now Hyundai in this project, how much have they invested totally, guys? How much have they invested totally? They invested 5 lakhs, which is the fair value, or let's call it as net investment in lease. What I'm investing? Expecting a return of 2 lakh plus 2 lakh plus 2 lakh, and assuming the other party does not buy the asset, you will get 50,000 residual value. This 2 lakh plus 2 lakh plus 2 lakh is called as EMI, correct, but it's called as lease rental. It's called as lease rental. We don't use the word rent, it's lease payment. This is the minimum amount to be paid, so it's called minimum lease payments. It's called MLPs, guys. MLP, minimum lease payment. Are you following, guys? It's called minimum lease payments. Fine. Minimum lease payments is MLPs. Are you following, guys? Okay. MLP, minimum lease payments. Now, by investing 5 lakhs, the maximum return I can expect is 2 lakh plus 2 lakh plus 2 lakh plus 50, which is 6 lakh 50,000. So by investing 5 lakhs, I am expecting 6 lakh 50,000 if everything is paid. So this is fair value of asset. This is gross investment in lease. What is gross investment in lease? The formula is very simple. 2 lakh plus 2 lakh plus 2 lakh plus 50,000. If I break this 2 lakh plus 2 lakh plus 2 lakh, in our example 50 is broken down into 10 plus 50. Who pays this 10,000? Lessee. The 40,000, if lessee doesn't pay only, I will get that, correct? So this is paid by lessee plus 40, guys, sorry, 10 plus 40, correct? 50 is broken down into 10 and 40. So my formula, can I say 6.5 lakhs is equal to this? So 6.5 lakhs is gross investment in lease is equal to MLP from lessee. What is MLP paying? 2 lakh plus, what is lessee paying? Zomato, 2 lakh plus 2 lakh plus 10,000. So MLP from standpoint of lessee includes the lease payment plus UGRV plus GRV. So this is basically MLPs plus GRV plus 40,000, which is UGRV, which is plus 40,000. So can I say the gross investment in lease, the gross investment in lease 6.5 lakhs is equal to 2 plus 2 plus 2 plus 10 plus 40. Maximum return I can expect. Will I get this? I don't know. But maximum I can expect is so much. Correct, guys? So 2 lakh plus 2 lakh plus 2 lakh plus 10 plus 40. So MLP from standpoint of lessee, 2 lakh plus 2 lakh plus 2 lakh plus 10,000. GRV plus 40,000. UGRV. This is the maximum return expected. 6 lakh 50. When you will get this? You will get 6 lakh 50 in the next 3 years, because I am paying here 2 lakhs for 1, 2, 3. For the next 3 years only I am going to pay this. Correct, guys? For next 3 years. So this, if I am getting 100 rupees after 3 years, what is the present value today? You know this concept, time value of money. Sir, getting 100 rupees after 3 years is not equal to getting 100 rupees today. So I am getting the 6 lakh 50,000 gross investment in lease in the future. What is the value of that today? So I will find present value of gross investment in lease. So what is gross investment in lease? If I have to equate 2 lakh plus 2 lakh plus 2 lakh plus 10,000 plus 40,000, which is nothing but MLPs including GRV plus UGRV. MLP includes GRV. I will find the present value of gross investment in lease. So basically I will do present value of MLP inclusive of GRV if lessee is paying plus UGRV. Assuming the present value comes out to be how much? This left hand side is 6 lakh 50,000. So this side, on the left hand side, GIL, we have 6 lakh 50,000. The present value of this, if discounted at IRR, you will get 5 lakhs, which is nothing but fair value equal to net investment in lease. So can I say gross investment in lease is equal to present value of gross investment in lease when you discount at IRR. So what is my earning? If I invest 5 lakh, you are getting 6 lakh 50. So my interest which I am earning 1 lakh 50,000 is equal to 6 lakh 50,000 minus 1 lakh 50. If I replace the numbers, interest is called interest. Have I earned it or yet to earn? So it's called unearned finance income. I'm yet to earn. So unearned finance income is called GIL minus present value of GIL, but GIL minus present value of GIL is equal to net investment or fair value of asset when discounted at IRR. That's when you use the word fair value of asset. Are you following? So three equations you have to remember. Three equations that you have to remember. Very simple equations, guys. GIL is equal to MLP from lessee, which is the 2 lakh plus 2 lakh plus 2 lakh plus 10,000, which is basically MLPs plus GRV plus UGRV. Then my net investment or fair value at IRR rate will be present value of GIL. Are you following, guys? At IRR rate, it's present value of GIL. Unearned finance income will be GIL minus net investment in lease, or in other words, present value of GIL. Are you following, guys? Now, when you are doing accounting in the books of lessee, when I am doing accounting in the books of lessee, guys, in the books of lessee, I will consider only this, which is 2 lakh plus 2 lakh plus 2 lakh plus 10,000. You will not consider UGRV because lessee is not going to pay what? UGRV. But when I am doing accounting in the books of lessor, I will consider UGRV also. This is limited discussion to explain what the terms are, just to do the one sum which is in our RTP with respect to AS 19, so that at least we have seen this sum. JR Limited took a mission on lease from Deluxe. Identify who is the lessee, who is the lessor. Lessee is JR, from Deluxe is the lessor. The fair value being 11 lakh 50,000. Economic life of the asset as well as the lease term is 4 years. Okay. At the end of each year, lessee pays 3 lakh 50,000 to lessor, MLPs. JR has guaranteed residual value of 70,000, GRV, on the expiry of the lease. However, the estimated residual value is only 25,000. Okay, here UGRV is negative, GRV is 70,000. Okay, IRR rate is 10%. What is the value of mission to be considered by JR Limited for the value of lease? Who is JR? Lessee. So in lessee's books, I have to recognize a liability of what I am going to pay. What I am going to pay is 3,50,000 will be paid in 4 years, plus in the 4th year I will pay 70,000. Let me put in simple terms. What I am going to pay is 3,50,000 into 4 plus 70,000 in the 4th year. But this I am going to pay over many years. I want to find the present value of that, because that is the liability of future liability values. So basically, I am going to pay in this question 3,50,000 will be paid in year 1, year 2, year 3, year 4. And in year 4, I will again pay 70,000 of GRV, and this year I will pay 3,50,000. This is the future cash flows. I want to find out what will be the value today of all of this present value of GIL, and that will be my computation, and that will be my liability. So simply go find the present value of all of that. If you go to the sum, the total amount I am going to pay is 3,50,000, 3,50,000, 3,50,000 and 4,20,000, nothing. Year 4 I am going to pay 3,50,000 plus 70,000 of GRV. So total I am going to pay 4,20,000. Discount rate will generally be given in question, IRR rate. Find the present value. So liability to be recognized is 11,50,000, 56,960. But however, the question says, if you see, the fair value of the asset is 11,50,000. That means if you buy today, it's only 11 lakh 50. But the present value of everything is 11 lakh 56. That means you are paying more than what you should pay. Therefore, you will recognize liability only at 11 lakh 50. Huge concept. For exam purpose, find present value. Compare with fair value of asset. 11 lakh 56 compared with the fair value of 11 lakh 50. Whichever is lower. Whichever is lower. Let's do one more sum in lease. Just for our control. Again, they asked JL Limited in one more exam. Same RTP. Leave it. Let me do AS. We are in answers. Let's see questions. Yeah. Quickly, guys. One or two questions and then we'll close. Just to do RTP questions of AS 19. So if I can go back to our questions. AS 19. This is about sale and lease back and what is finance lease and operating lease. Easy one. Have a look at that. Let me do this sum. Computation of unearned finance income. Okay. These two questions needs some more concepts. So I will end by saying AS 19, we did only the latest November 23. Here I am focusing in AS 19 mainly on terms for you to learn. Terms for you to learn. Detailed AS 19, in a marathon half an hour, we need 2 hours at least. So description of this video, maybe I will try to share AS 19, 20, 22 alone, separate videos if you have the time. But if you've already learned, you're good to go. So again, to conclude, we have done all the standards in detail, all questions. AS 20, EPS theory is done, practice more sums. 22, deferred tax, I have mainly focused teaching you on the shortcut. And AS 19, we have learned what are the basic terms. Now it's only going in application of that. So in 3 hours, we try to cover all the accounting standards, guys, and that's the idea of it. So thank you for staying till here and all the very best for the exam.